um, and at the same time has to figure out a way to coax the Fed into cutting. And the thing is, there are people within the Fed that the Trump administration does.
What up, everyone? Welcome back to Financial Education and Business. Obviously, today was a terrible day. The market crashed, and it's been ridiculous out here. Um, we've been getting beat up. We have been getting beat up all day. Um, let's see what is going on in the market. Let's react to what's going on. It's been a ridiculous day, and hopefully there's some positive news eventually, but let's see what really caused the market to really plummet the way it did. Um, and let's just go from there. Let me just make this fit to size. Mm, okay. All right, we'll watch this video for a little bit, but then we'll also trying to figure out a structure of what the hell is going on in the market.
Bad. That's a
That's
giant.
really high.
That's
Wait.
giant.
Especially, hold
What
on,
exactly is
especially,
what
I want to
exactly?
These
bring,
screens.
hold on. So I want to bring somebody on who will help us with this topic. But before we do, we just have to ask one question. Chris Patel, do you know who Aaron Judge is?
Thank you, dude.
Both of you
Dude,
leave.
we're too busy worrying about the markets to know about some B-list New York City player who can't make the World Series, dude. Give a fuck about Aaron Judge.
Can't
Aaron
believe
Judge, last name Judge, should have been a lawyer, bro.
can't believe this. Dougie, what's going on?
See, Doug doesn't know how to use the mic either. I'm not the only one. Y'all are making fun of me. Fuck you, Doug. You don't know how to do your mic either.
We get a 2% down day. People don't know how to unmute.
I was just on another call. There we go. So this mic's working. All right.
Doug, are you
Well,
outside in the sun right now? Is that why you got the sunglasses on?
Nope. When you come to Houston, you'll find out, Chris.
Is now going to be limited. Now, of course, there are sites around the country where you can, get dry gas, which is literally just putting, drilling for natural gas itself. But with the amount of draw that's currently happening with all of these LNG facilities pulling natural gas from inventories, you've got a cold spell here in the south, so you've got pull from users here, and then also all these data centers are coming online around now, so they're all getting piped via natural gas. So a lot of these power plants are drawing
Yep.
natural gas. So you've got this giant draw of natural gas, but the impetus to drill more natural gas is not necessarily there, right? Well, I mean, at $4, of course, it's
They
there, but
could
the ramp up
capture it if
takes
they
time.
wanted to, Chris. That's what 90% of all the flare you see at a refinery is natural gas that
The
they just
problem,
they don't want.
the the problem with the flaring thing is that there's not enough infrastructure that goes around to collect that on every field. I mean, imagine right now constructing pipelines to a field, especially like
I'm not talking
in
about
the
a field. I'm
Permian.
talking about refineries. Refinery,
Mhm.
large centralized product. They could capture that if they wanted to, but they flare it off.
Really? I didn't know that. I don't know how much of it can actually be captured, but I think that's something that maybe Matt knows more. But the point is, natural gas right now, there's just a lot of demand for natural gas in the country and not that much supply. Now, here's the thing: a lot of natural gas companies, they don't want to risk drilling more and increasing their drilling programs if it means that natural gas prices are just going to come back down again, in which case now you get stuck with
Yeah,
a
that's a
whole
great
lot
point.
of capital expenses. Yeah, so the thing is, at some point natural gas companies will get ramped up. I think that the Trump administration is probably calling every energy CEO they can and just saying, you need to start drilling ASAP, get this goddamn supply going. And the thing is, for the next 3 years, I don't know if you guys have seen the chart with how many LNG facilities are coming online. It is a lot of facilities that are coming online. So
They have to
upstream
go
and
on.
Yeah.
I
right.
mean, the amount of
Problem the
data
problem
centers
is
coming in
the
is
the
crazy.
price of oil is already so low, so there's no
Look at the increase that we've had.
All right, let's just go ahead and talk about why the market is getting beat up here. Obviously, there's a lot of reasons, and let's just quickly go through it. So, on Thursday, which is today, the stock market tumbled primarily due to investor worries about the artificial intelligence AI bubble. That's literally across the market. And one of the main reasons is that, well, you have a bunch of companies like OpenAI promising that they're going to spend almost $1.5 trillion or so in the next 3 to 5 years. But in reality, the company is only making a revenue of like 13 billion. So open um, open AI promise of spending over a trillion while making billions in revenue. And this is what's kind of driving this AI bubble theory. And we'll get into it in just a little bit. Overall, the S&P almost down 2%, the Dow, the Nasdaq, obviously that's the tech bubble, which has been, it's not a bubble, I don't think, but the whole tech industry has been just dying off. But so AI stocks valuation concerns, and that valuations around, well, there's companies out there that's a little promising, over promising, and they might not be able to. So this is not that they won't be able to, it's the idea that, oh, these companies like OpenAI might not be able to fulfill those promises. There were renewed concerns that the price of AI related superstar stocks like Nvidia and so on are the problem, and Google and Nvidia have been declining throughout the day. Interest rates and interest rate uncertainty also, I mean, I don't this is not going to be a thing. I think the Fed is going to come through, especially with the way the market is reacting. Questions arose over whether the Federal Reserve would follow through on expected interest rate cuts. The recent the government shutdown has led to delayed economic data being released. I think the fact that we're not getting CPI, GDP numbers, it is a little sketchy. Post shutdown uncertainty. Once the government did open, the government decided decided not to give us some information like information around whether we're going to get those numbers, and so economic data that investors can use to make decisions. So that kind of spooked the market between the tech sector having an issue, while in reality, people are using a lot of these AI infrastructures, but they're worried is there an overspend? As you can see, the Dow, Nasdaq, S&P 500 all down today, over 1%. And the main concern around OpenAI, there are questions and skepticism regarding OpenAI's financial model due to its massive projected spending on AI infrastructure, which exceeds its current revenue. So trillions in spending. OpenAI has entered into numerous partnerships with NVIDIA, AMD, Oracle, reportedly committing to over $1 trillion in spending over the next 5 to 10 years to build out its AI infrastructure. Some of this spending is through a venture called Stargate project. This project is in Texas and is expected to be aimed to invest 500 billion to build a new AI infrastructure. In reality, a lot of this building now is actually it's being done right now, and it's not expected to be done this year. Billions in revenue. So while impressive for a private company to be making billions in revenue, OpenAI's revenue is significantly smaller than the spend commitment between 12 spend commitment. Recent report indicate that annualized revenue is between 12 to 13 billion dollars. So this company is private, and OpenAI is a private company, and they don't non-for-profit company, and this can kind of maybe show like why um, you know why investors are not even seeing the full picture. Is they're making a judgment on a company that is private and they don't really know the books. And so maybe this is a problem. This has happened in the past, and the way that um, the CEO Sam Altman kind of shows up in interviews is not very trustworthy, like snake oil kind of thing. But in reality, he is selling a real product used by real businesses and partnering up with real corporations that are seeing efficiency due to this financial discrepancy. So this created a significant cash burn problem. As of November 2025, analysis of leaked internal documents suggested OpenAI was spending more than double its revenue. In one instance, a report revealed OpenAI spent 8.7 billion on inference alone in the first 3 quarters of 2025. Guess who is in the business of inference? AMD, which is one of my favorite companies, raising questions about how its massive expense are covered. If you're not making the money, how are you covering your payments? How OpenAI plans to cover the cost? Aggressive fundraising and new revenue streams. In reality, if this company went IPO, they will be in billions. Investors will give them the money to go IPO. They'll buy the stocks. There's demand for the company right now. And so a lot of people do think that they are way underpriced. So this is why I kind of think that if the company goes public, I think they might get that funding that they need to get to those trillions of dollars. But that fear of AI build out infrastructure expense is yet still above what they are making in revenues. So this aggressive fundraising and new revenue streams, the companies is pursuing multiple avenues to cover the spending gap. This includes new fundraising efforts, developing new revenue line beyond its existing products like ChatGPT, and using debt financing. So there's a whole bunch of products that OpenAI is thinking that they can make revenue in, and that's um, sharing in the income of a product they might come up with. For example, they want companies to companies who want a certain kind of research developed around a certain medication. Well, OpenAI can do that research on that medication, and if that medication does work and is being sold to the public, then OpenAI will be partial revenue share of that product. And that's only one example right now, but in the future, I think there's going to be even more and more products like that, especially when it comes to research. And it takes a lot of trials and tests. But when you can have a lot of this research and tests just on in a neural net, like over ChatGPT, DeepThink, like we have right now, we look at OpenAI and we see how amazing it is. But think of developers that are using OpenAI and even maximizing that to their advantage. And they still have the most basic version of the reality of what OpenAI's products can actually do. And so, um, obviously, OpenAI isn't going to give their best products. They probably want to keep that close for the worst times, and use that to their advantage. So that's what I'm thinking here, is that OpenAI is probably going to eventually come out with all these whole bunch of products they can end up doing some kind of revenue share. And then they got circular financing is one of the problems that they have. So some analysts have raised concerns about the web of circular financing, meaning OpenAI will say, "Hey, NVIDIA, hey Oracle, we are going to promise that we're going to buy $38 billion of products in the next 3 years." So they make that commitment the stock goes up. And then Oracle will then turn around and say, hey, OpenAI, we will invest $30 billion into your business. So at the end of the day, no new money was created. It's just literally just circulated between those businesses. But now imagine this being circulated, 100 other um, 100 other businesses where they're kind of paying each other, which sometimes can be seen um, as a kind of pyramid scheme. Future profitability financial disclosures show OpenAI projects annual losses until around 2028, after which it aims to become wildly profitable, according to the CEO. However, this is based on a bet on market dominance and requires significant capital. And this is exactly why that I think a company like Google, like people don't look under the surface. If one of the best AI companies is being mispriced because of the spend problem, well, Google has almost everything ChatGPT it can do everything and more what that ChatGPT can do. So, and they have the capital and the means to actually innovate without running out of money. And they have their own chips. So this is why like a company like Google should be valued even way above what a company like OpenAI should be. I always say Google's worst fear is not that they are incapable, is that they are capable, and if they do, then they might be scrutinized by the government. Investor concerns so unsustainable growth, the scale of OpenAI's spending, and the nature of its deals have led to companies with dot-com bubble feel, with some expression concern that the current AI boom is unsustainable. I disagree. Dependence on partners, yes. So this is in reality what's actually causing these stocks, the entire stock market to kind of tumble, with the government not showing data around CPI and job numbers, with the government finally opening up, and with the government finally opening up and the numbers really not being provided to investors, like all these cause investors to be scared and run in a different direction. So this is why the market's down, and then they're seeing all this spend going around, all this spend around a around AI. Now, if we look at the margin, there's definitely an interesting margin issue going on. So if we look at margin, um, margin debt versus cash, cash credits, I should have said credit, there's actually a significant difference here. How is the provide margin debt versus cash credit data from the Fed? So this is actually a very important thing, is that we're seeing that there's even more margin debt in the economy. So as of September 2025, FINRA reported the following statistics. Debt balance in customer margin accounts is $1.2 million. Free cash, 1.2 billion. Is that? This doesn't look right. So debt balance in customer margin account is 1,126,494. Free credit balance is 204,000, and then free credit balance in margin account is 194,000. If these are in millions, then in millions, so that means that there is more debt balance in customer margin than there is even a combined free credit balance in cash accounts and margin accounts. So if we look at, show me a chart of this. This is data FINRA, by the way, posts every single, I think, quarter. Um, let's see if we can find a chart that shows the issues that are being caused due to the snapshot. So FINRA, um, to do um, FINRA. So let's say FINRA report on uh, margin debt and credit cash credit credit report as of today. So this is very important because we're seeing that there is this significant gap between what the amount of margin and the amount of cash that people are having. So here's a good representation: margin debt and S&P 500 real value. So we're seeing that margin debt kicking up. Um, we want to see the FINRA margin debt and the S&P real value inverted. No. FINRA margin statistics. All right, let that load. FINRA margin debt monthly. So this might be a good chart here. This is a monthly report of margin debt versus cash. That's what is important here. Margin debt. Look at this. Margin debt is 1.2, 1.3, 1.2 in 1.2 billion. FINRA margin debt is at the current level 1.2 billion, up from 1.06 last month and up from 817 billion 1 year ago. So this actually number is in trillions. So as you can see, in the past year, obviously we hit the lows in April, but since then margin debt has just continued to go up since April. And we haven't really stopped seeing that for a while. In 2023 is the lowest that we've seen it, and really hasn't peaked to that point for a very quite while, and is above any historical numbers as well, which is pretty scary. And that's why a lot of people are kind of scared. Tick up the market fund customer tick up. This is why a lot of investors are kind of scared right now, because those numbers are really scary to see. So margin debt and three FINRA margin, S&P reports, and margin data statistics. Let's see, this might have really useful information. No. All right, obviously it's not showing up, but as you can see, margin debt is going up, as we saw the numbers already, and this is why investors are kind of scared. So here it is. So while margin account, while the stock chart cannot be used, they can't. They're not going to show me the created chart with recommended charts. Microsoft FINRA margin balance ratio. Let's see if this is a good enough source to show those numbers. So US FINRA margin balance, S&P total, US total GDP. Yeah, so US total market cap percent of GDP. So it keeps as a percent of GDP, it is not slowing down. US federal funds rate, I mean, it's gonna show higher once again. Yeah, so we are up. So if we go back to like 2019, we flattened out. There was barely any margin. But since then, we have just been skyrocketing, and we can kind of see that federal margin debt versus over federal funds rate is kind of going down. Historically, it is, as you can see, this line seems to be above, and it is above right now, which is not a scary thing. But um, overnight index swap, federal funds rate versus S&P, U.S. federal funds, FINRA margin debt. Let's look at it over the past year, and this FINRA margin debt balance divided by currency in circulation, and S&P divided by the currency in circulation. So this is the S&P 500 and FINRA margin debt. This is the one we were looking at. Where are we at historically? Well, in 2018, I mean, here's the COVID era, we kind of dropped. And if we look at these numbers, it kind of shows that. And let me actually go find a better image while we listen to this podcast here.
valuation is built on nonstop growth for the next 10 years, then it's not really a company that you want to be in, right? Like, here's an example. Everyone knew that Tesla was going to be a great company in 2020, right? People bought that thing at $450 a share at the time. What did they do? Eventually, Tesla did catch up to the demand, but they bought that literally that cash flow way into the future, and then they broke even 5 years later. So it could be very similar to that with a lot of companies where what you're doing essentially is buying something with the expectation that this is going to grow at 35% year over year for the next 5 years. So my thing is, that's fine if you think that they can execute at that level, but just make sure that you're not positioning your portfolio to be fully into that thesis. Have some safety as well, at least, especially if you've done well in some of these names, bro, buy some protection just in case some BS happens, in which case the entire general market takes a dump. Because I can't, there could be another DeepSeek moment. You don't know. I don't know. A lot of what Jensen is saying, all these guys say, they're of course going to talk their book. There's nothing wrong with a CEO talking their book. Have you ever seen a CEO outside of Elon saying, you know what, don't buy our stock, I think we're overvalued right now? No, because the board would replace his ass in a heartbeat.
That's true. That's true. You're not wrong. Look, I agree with you. I think I don't know if any of these AI names, whether it's the neoclouds, whether it's even AMD, Nvidia, et cetera, are meant to be held forever. Like, I think Amazon can be held forever. I don't know if Nvidia can be held forever. I mean, like, at some point, the GPU sales probably stop. But the point is, over the next 5 years, to make it simple, a 5-year trajectory, do we think these trades, plays, whatever, are going to be more valuable than they are today? Because I would say today we're, a year into a real build out, so maybe a year and a half. I mean, you either believe that or you don't. And if you don't believe that, then you don't believe the AMD revenue numbers. You don't believe NVIDIA can get to 10 trillion. You don't believe NVIDIA should be anywhere near 5 trillion. You go on and just, you get out of these plays and you get into safety, as you said. And there should be a balance between both. But I think right now, based on the numbers we're seeing, it really does feel like there's runway minimum for the next 2 to 3 years, probably the next 5 years if the numbers really manifest themselves. And as Steve said, humanoid, robotics, drive, if all of that compute is needed, it seems like these are going to be plays that have the demand. I don't know what their stocks do, but theoretically they should be more valuable.
Has anybody seen any? Sorry, Chris. Has anybody seen related to the next couple of years and what we've seen already? Has anybody seen shovels actually turning over, dirt being moved, like buildings actually being produced? I haven't seen any of the companies that would actually be doing that work. I haven't seen any earnings reports or any of those public companies having blowout quarters because we just had to build 4 X billion-dollar data centers.
Amazon's Project Rainer that they just built. They're also building. They're building another one adjacent to it. So they just finished that. I'll send you the video, but I get what you're saying.
So there's a couple there.
Doug, you're talking about the Bitcoin miners, all of them that are up like 1,000%. All of them have all this land. That's what you're talking about, right? Turning a facility into an AI HPC play. I would just say it's the Bitcoin miners.
Yeah. So the Bitcoin miners have a whole bunch of ASICs. So what good does that do anybody?
Well, they own the land and they've got the power, so it's plug and play is the idea. So that's why they've run so much. But another thing that's done really well is the electrician groups. So you can Google a list of some of the biggest companies that have the most certified electricians in the company. Then take a look at their stock chart and their income statements. The proof is there on that side, Doug. But I think some people underestimate what can happen in 10 years. They call this Gates law. You overestimate what can be done in 1 year, and then the progress that can actually happen over a long period of time. So I think if people are looking at where's the ROI, even though we're 2 months or 2 years into this build out, you just have to think in decades, not necessarily months. As they should call it Doug's law, because I hear him say this all the time. This is the worst AI will ever be. I hear him say it all the time, and it's 100% true. It's only going to get better from here.
Bro, I think it's really important to step back, right? I know a lot of us here aren't the biggest fans of Sam Altman, but I also think we got to listen to what he's saying. He's contracting $1.5 trillion of compute right now. Elon's talking about building his own chip farm. Like maybe the numbers are off, and maybe they're off by a couple $100 billion, maybe they're off by $1 trillion, who knows? But like the fact that the ambitions are this high because they believe this is the opportunity. I mean, it's not even just a like social experiment. It is a health of the American 401k experiment. If this doesn't work in the next 5 years and all of it goes to shit, I mean, we're talking about .com crash, NASDAQ's down 80%. What is going to happen to this country? What is going to happen to everyone's 401k? What is going to happen to the people that are close to retirement that at the end of the day, they've seen gains over the past 3 years and they were thinking of how they were going to live their life in retirement, maybe not be super luxurious, but they're thinking like, hey, I've got some good gain. And then all that dissipates. Like it has become too big to fail. I hope it doesn't fail. And the ambitions that all these tech leaders are putting out, I think we have to take it seriously. Will it fail? No one knows. But if it doesn't fail, then it's going to change everything. And if it does fail, it will destroy the country, in my opinion.
Well, what's the definition of failing?
Like
Because
if it's a
keep in mind-
NASDAQ fell 80% in the .com bubble. If that happens, because if the NASDAQ's only hyped up on AI and that happens again, forget 80%, let's say it's 50%. I mean, I don't know.
I don't think.
Yeah,
I don't
but
think that's
play it out. If the demand for chips goes away, let's just say demand of chips goes away next year. Let's say the build out's over. How does that negatively impact anybody in the Mag 7 except for NVIDIA?
No, I think
that's the point. It's
entire-
not.
Like it's not
No, but
impacting any of their profitability.
No, but then the whole reason this bull market started at the launch of ChatGPT was because there was this revolutionary new technology that was going to change everything. If that technology isn't real, then what is the market hyped up?
We're already seeing the advancements in Microsoft. We're seeing the advancements in Alphabet and Amazon. Think about all the things that their cloud services are able to do today that they couldn't do in 2023. So if the
Well, that's my
build out
point.
stops, but I'm getting there. If the build out stops and the capital stops going to NVIDIA on an expansion and it goes into just maintenance mode, these companies are still going to monetize all their assets and grow earnings. Now, NVIDIA may not be growing their earnings at the same rate. They may be at a standstill and have to pull an Apple and just buy back a ridiculous amount of shares and live off of chips that have to be replaced. But these other companies, they're still firing on all cylinders and they're still monetizing. And they won't have to spend as much. Their free cash flow expands. They go into buyback mode again instead of CapEx mode.
You're right about that, but I think the general excitement to even care about the markets dies down significantly. Again, Oracle, AMD, all these market caps are propped up because of these deals that Elon, Sam Altman, Samsung are laying out.
But the two companies
companies
but think about it, the two companies you just said, how much of the S&P do they account for? Oracle and AMD versus these other ones. I mean, there's a difference between excitement and profitability.
I think
That's fair.
This is something to take a look at when we think about froth in this market. If you see how much of the S&P 500 right now is just 7 companies, it's close to 50%, right? So do I think that Amazon, Microsoft, Google are going down 50%? Hell no, not even possible. Not in my opinion. At the same time, you have all these other companies within the market. There's literally 463 other companies that are becoming more efficient, that are gaining profitability because of all these AI products that's out there. Right. At the same time, you also have Fed rate cuts, which are going to expand their margins. So if you're telling me, hey, I think the big crash is coming in 2026, I don't think so. Not with rate cuts that are coming in. Which we're more likely to see is a broadening out of the rally with money that's saying, you know what, I don't want to be 100% in all the AI plays. I'm going to go into other things. Think about what Doug just said today. Right? He's an investor. He said, you know what? I don't want my entire portfolio to be nothing but AI. I want it to be in some other names as well. So that is what we saw today. We saw rotation, which is healthy. That's a market rotation. We did
so
not
Chris,
see,
let me ask you this, and I agree that's healthy. Let's say Steve is right and chip demand tomorrow is 0. what do you think happens to the Nasdaq?
Chip demand is never going to be zero.
No,
What's
I
gonna
agree. It's
happen
not.
is-
I agree with you. I'm saying
Right.
the thought experiment. What if it does? What if it is a .com type of scenario where we overbuilt way too much fiber
It-
optics? All this.
the,
What
the
do you think happens?
challenge the challenge is not that we have a .com bubble scenario. That's the one major difference between .com and us right now is that most of the companies, as Stephen so eloquently put it right before this, most of the companies that are financing the build out right now are cash flowing businesses. They actually have real business models underlying them. And the companies that could theoretically go to zero or have a 90% correction are the companies that are so insignificant, that are so on the fringes, it's not going to do anything to the overall market, right? The other thing is the rest of the world hasn't even started to participate in a lot of this upside when it comes to the AI and everything else. So there's still going to be demand. It's just what you're going to see is compression of the multiple in the AI leaders, where instead of companies like Nvidia getting a 50 multiple, they're just going to retrace down to a 20 multiple, which is not a growth multiple anymore. That's more like a maintenance multiple, especially if they have a lot of free cash flow. They're going to keep buying back shares, in which that's going to prop up the stock price. But you're just not going to see Nvidia go to $1,000 overnight again, or at least not for a long time.
I think it's a good point. Basically, you're saying there is a very low chance of a .com bubble. There could be a compression in the chip plays, but that would not lead, and that's a really good point. That would not lead to the overall like 80% drawdown we saw in 02
No.
in the
That
other
was
players.
02 was completely different in that most of these companies weren't even generating any money. They were literally burning cash on nothing. Like pets.com had no product, no nothing, and they were getting millions upon millions of dollars. And sometimes their valuations were in the billions of dollars range. So if you were to ask me, Chris, what's the scenario that happens here? I think, let's say AI, the demand for AI starts to get challenged a little bit. What you're going to see is a re-rating of some of these companies down to multiples that are already existing right now. Technically, as Steve put up right there, if you look at the multiples on most of these companies, they're okay. Like, I think Nvidia's multiple could go down to like 22, 23. Is that really that bad for the entire market? Not really. That money is just going to flow into other parts of the economy that are not getting as much love. That's
Well,
keep
I,
in mind-
I agree, but I don't know if Nvidia's multiple gets cut in half. I'm not sure if it just flows into other companies, even though technically
So
you're right. it should.
let's leave NVIDIA off of this for a moment, okay? Amazon, Microsoft, Alphabet, and Apple are all generating more than 130 billion in EBITDA. Anybody who says that this is like .com is just simply incorrect, because in the .com era, we did not have the .com infrastructure funded predominantly by these companies that are putting up these numbers. We've never seen these types of numbers before. Alphabet's put up 151 billion in cash from operations, and you have another company, Meta. So you now have 5 of these companies doing more than 100 billion in cash from operations on a TTM basis. So there's a lot of capital being made, and these companies are likely to keep expanding and monetizing their assets. So I'm not really worried about it. I'm really not.
So do you guys here, and this is a history lesson, do you guys know what popped the .com bubble?
I do, but I'll save mine for last.
Anyone?
I was there.
Okay, so what popped it? What was the trigger?
Well, one thing was the Fed raising rates, but I'm sure there's something else you're talking about.
No, it was
That's
not.
what I was going to go with. 6 rate hikes.
No. VCs, they stopped putting money into the .coms. And you know why they stopped putting monies into the
Well, they
.coms?
ran out of money to put into .coms.
No. They still had money. They just lost it. Remember, investors are always throwing money at things that are complete trash. No, it's the lack of confidence in the ability to throw money at trash that causes the bubbles to pop. The challenge is there was one company, and I don't know if you guys remember, which company was the exact top of the bubble that popped. Steven is like just giddy. Go ahead, Steven. Tell him.
You're muted, Steve.
I want somebody to guess because it's just
Hey, I was working for one. It might not be the one you're thinking of, but I was working for one for absolutely sure.
Yeah, wait, so Chris, you're saying a VC company, like a startup, basically? That's what you want us to guess?
There was an article in Barron's that came out, and basically MicroStrategy was the one that popped the bubble
Yeah,
in
I
2000.
forgot. Yeah.
If you guys remember, MicroStrategy came out and it was a real shit show. Barron's had actually said something about it, and boom, everything, like, it was like this moment where everything was revealed, and then every VC LP, they could not raise money anymore for any more startups. And at that point, all the startups were like, hey, we need money to keep going. People were like, nope, we're not putting any more money in. And that's what like destroyed everything. As far as I can tell, Microsoft, Amazon, Google, not a single one of them has said, listen, we're not putting any more money in AI. The day that the day that Microsoft, Google, Meta, Amazon say that, I think we're done with the CapEx, I think we're going to focus on share buybacks, is the day that the bubble pops. But here's the thing. They are so into the system that they will never come out and say that outright. What they're going to do is just level off the demand and the growth in demand. That's it. So,
and keep
The
in
latest
mind
thing that's going to happen, Chris, is when they come out and say, "Oh, we're going to concentrate on buybacks," they're going to have a big buyback opportunity the very next day and be able to buy their shares 50% of what they were the day before they announced it.
No,
And-
but
and
Chris,
keep in
Chris's
mind-
point is they won't fall 50%. Chris's point is the market's gonna be like, great, no more freaking Nvidia tax.
I'll tell
Which
you
is
who's going to be buying back their shares. It's going to be Palantir when they're back at $50 again. That's why they're loading up. Look, Palantir keeps growing its cash pile. Okay. Why does a company keep growing its cash pile? The reason why is because they know they are overvalued. When they're finally correct, they're going to say, hey guys, now we can start using this cash pile to buy back our own shares. Until then, issue all the shares they want. That's what they're doing. It's so easy to see, but enjoy
I bought
it.
99 shares of Palantir today, and the money I would have spent on the 100th share, I spent on 2 T-shirts.
nice.
Well,
Well,
Palantir's not sitting on
Talk to your
CapEx.
friend Eliano, Chris.
So
Yeah, I don't
before
think
we go
Palantir-
to Palantir, if we're
Palantir's
even
not
going to
sitting
go
on
there.
CapEx. They would be the beneficiary of.
By the way, Burry put on puts for Palantir. What was his strike price?
The strike was 50
$50. So I'm just saying.
by next
think one
year
day-
too. So but I think he sold it already too.
Hey, Amit, remember when we were 2 years ago and everybody said 50 was horribly overvalued?
Yeah, I remember. I deeply remember. I remember a guy on Twitter went on margin, bought like 5,000 shares at 50. And I was just like, that seemed, he borrowed at 5% for an asset that went up more than 3x. It was a good deal. But yeah.
Well, before we go down the Palantir road, keep in mind with the dot-com bubble that there were 2 things that we did not discuss that absolutely destroyed it. Companies were getting valuations and raising capital off of eyeballs. Because keep in mind, the internet was brand new and nobody wants to address that. Nobody knew what the internet was going to be at that time. Like if you were a teenager or in your 20s or 30s in 96, 97, you still had a 14.4 dial-up modem. You didn't even have a cable modem. And people companies were showing metrics about how many visitors their website was getting and what they could monetize the eyeballs for advertising revenue. That didn't mean they would actually be able to sell advertising revenue because it was such a new thing. And that's one of the big reasons why, and then that stemmed aggressive accounting and caused venture capital funds to pile money in. And then when the return wasn't there, the bubble popped. That's not happening with this. And that's why I keep saying, like, the correlation between the two is simply incorrect. You can say all you want that at some point the build out's going to stop, and I'll agree with you. None of us know when the build out's going to stop. And the big difference is this is real profitability fueling this. This isn't venture debt. And that's the biggest difference. Oracle's the only one.
Huge difference. It's a huge difference.
It's a huge difference. Oracle's the only one outside of Meta's latest deal that's actually going to the bond market and issuing debt to build this out. So I'm not seeing, when I look at how profitable these companies are, there's any issue on the debt side or the funding side for this.
Just to break this down into smaller chunks for folks that might not understand that. For those that don't know, I have a laundromat, right? I bought it with cash. I own every single bit of inventory, all my pieces. The only thing I don't own is my property, and I pay rent for that, and I have a great lease for it. Super low cost. 2 new laundromats just opened up down the road. They're new construction. Those are every bit of $2 million build outs. You know, those are financed. Do you know what kind of pricing power I have against those? My wife asked me if I'm worried. I said, I'm not worried at all. We can run our margins down to nothing, and they can't. I can put those companies out of business.
It's a very good point.
Because I have a balance sheet that is a fortress. I have cash, I'm profitable, and I don't owe anyone anything.
Yeah, and that's a great point by Dougie, because if you add up the cash on these companies' balance sheets, I mean, how much cash does Alphabet have just sitting there? 90 billion in current? That's not even long term. So it's a silly thing. Now, at some point, this is going to go into maintenance mode. None of us are going to know it till it happens. And it could be a year, it could be 3 years, it could be 5 years. And I keep changing my target of when it's going to be. But when I look at this, which is very impactful, okay? This is just Amazon, Microsoft, Meta, Alphabet. And when you look at the actual numbers in 2024, they spent, let me just drag that down. They spent 217 billion in capex. It was a 55% year-over-year increase. In the trailing 12, they've spent an additional 52% on capex, and they've gone to 329 billion. The expected for 2025, they're expected to spend 354 billion, 63% year-over-year increase from 2024. And they're also expected to grow this past 400 billion next year, maybe closer to 450 based on what they said on their earnings calls. So we know, at least at this point, it's not going into maintenance mode next year. Now, 2027 may be a different story, but I'd be willing to bet we got at least another 2 or 3 years left of build out. And then the real $1 million question now is, after the build out happens, what does maintenance mode look like? Does maintenance mode look like they have to maintain this type of spend, or does this type of spend get cut by 30%? Because if this gets cut by 30%, I don't even think that that's bearish for NVIDIA or an AMD, because it is so much money going back into the ecosystem. And then these companies are going to be able to monetize all these assets while depreciating their current inventory off the books. So
basically what I'm hearing from you and Chris, and I think this is a really good point, is, and this is the point to drive home for today. You guys are saying if chip demand went to zero tomorrow, it would affect one major company.
Not to zero. Not to zero.
No, but I'm saying, if we were to go to the logical extreme and or the illogical extreme rather, and because I'm saying, let's steelman the bear's worst case scenario.
Sure.
That chip stop tomorrow. You guys, which I think is a very good point, quite frankly, it's even changing how I'm thinking of this. You guys are saying it would hurt NVIDIA and CoreWeave and AMD, Broadcom. It would really not matter to Google. The sentiment probably would be ugly, and Google's probably down 20% the next day. But at the end of the day, all that money is just going back into the business.
Sentiment would impact everybody short term. But what happens when that next earnings call comes out and Alphabet's profitability and revenue grows quarter over quarter, year over year? Same with Microsoft, same with Amazon, same with Meta. Is they're not freaking making money selling chips?
No, but this is a really good point. So for everyone freaking out about .com bubble collapse, let's go to the worst case scenario. A lot of companies probably get hit bad when the chip demand goes to zero, which is very unlikely to see. But if that does happen, the 7 companies that make up, or the 6 companies that make up the majority of the S&P outside of NVIDIA, they get a ton of more free cash flow, a ton of
Yep.
share buybacks, and they keep
Yep.
the party going.
Yes. And they get bigger margins on free cash flow. They don't skip a beat because nobody's getting rid of their cloud services. And chip demand's not going to go to zero. It's just going to go into maintenance mode. And we have to see what maintenance mode looks like. And look, if we're at a point, think about this. If we're at a point where the last year of build out is 500 billion from these 4 companies of CapEx and maintenance mode becomes 350, is 350 that crazy of a number that's going to make NVIDIA go to freaking $30 a share? Absolutely not.
Good
NVIDIA
point.
gets hit a little bit. Okay, great. But the rest of the market's going to get a lot of productivity, like Chris said. There'll be a lot of efficiency gain. And ultimately, the biggest companies are still going to improve their bottom line.
And here's the other thing that's really important about this. And this is why when you steelman the bears argument, it's even hard to get to that crazy conclusion. The cloud revenues for Amazon, Microsoft, and Google, which are so lucrative for them, is because of more AI workloads. Like that's really been why Azure is growing 40%, Google's growing 35%, Amazon's now going back to 20%.
Let me add one thing to that for you, Amit. I'm gonna make your point even stronger. Most companies are on enterprise agreements for cloud services. Most companies every year need to get more space. Dougie's shaking his head. Yes, he knows exactly where I'm going with this. If you're on Microsoft, you need more in their environment for SharePoint, and you need more in their environment for OneDrive. Same if you're on Google services, cloud services, you need more for their Drive services. So it's an infinite loop because now companies are not, this is not the 80s and 90s where you need to store things for 7 or 10 years of paper files and you have to outsource it to Iron Mountain because you don't want to store it on site. Now you're able to make digital prints and store something that has a 7 to 10 year retention period. You're able to store it in the cloud because it is acceptable to have a digitized scan. So the space that you need is still increasing.
Yeah, and those AI workloads need data centers and they need
Right.
chips. Now, here's the actual bear case. I think this is how you get to the conclusion of actually bearishness. What if there is no demand for cloud? AI cloud in particular. What if that goes away? Because there's no quote unquote ROI on AI, right? Like all these companies.
I don't think that that's ever going to be the case. I'm
Well,
sorry.
so if you don't think that's the case, then it's really hard to find that big bad boogeyman bear case. Because
Well,
if the AI cloud demand is going
It's
to
not
be
that you don't think that there's a case. That's not a case.
Yeah, that's not
Like
a case.
if anybody who works for a company that is signed up to these companies, it's not a case. That's not a thing. That's not actually an argument. Anybody who actually thinks that is so misinformed. They should go invest in something else.
Cloud compute is going to CAGR at 15 to 20% per year for at least another decade. Like everyone, there has never been a time in my lifetime where people have said, you know what, we need less cloud services because everything, if you know how much stuff is still on-prem, I think it's still like 70 to 80% of all applications are still on-prem. Okay. Cloud compute is going to have a long tail going forward. AI cloud compute is going to be sold as a side thing. The question is going to be who's going to be the ultimate winners in this. In my opinion, as far as I can tell, Microsoft, Amazon, Google, and if Meta ever decides that hey, they want to get into the fourth leg of the race, they can get in. IBM could do okay. Oracle will technically do okay, but they also have they have a lot of ambitions to become one of the biggest hyperscalers. So they're another question. But to be on the safe side, I don't think Amazon, Microsoft, and Google are going anywhere. They're going to do fine. By the way, I just want to show people the article, the exact top for the article right here. This was from no, actually, let me wrong screen. 1 second. Let me just show everyone.
Guy can't get his mic on. Now he can't get the right screen going.
Sorry, I'm
Well,
sorry.
but see, Chris, before you
Yeah.
bring it up, I think just real quick,
Yeah.
this is the biggest takeaway from the show today. If you think chip demand goes to zero tomorrow, NVIDIA, AMD, the neoclouds, they get killed, but everything else should be relatively okay, even if the sentiment goes down because the free cash flow comes back.
After Chris goes through this article, I'm going to bring something up.
Yeah.
On the second hand, if you think cloud AI revenue is real, and we can see it in the earnings, all that cloud AI revenue is coming from the chips. So it's like if chip demand goes to zero, okay, bearish Nvidia, which is very unlikely. If it doesn't go to zero, then all the AI infrastructure is still going to generate a lot of ROI for the clouds, which means it's just unlikely to be .com.
Yeah, I don't think we're gonna. This is not a .com scenario, but at the same time, I do think Nvidia and possibly AMD are gonna get cut. Their multiple's gonna get cut down, but at the same time, remember if they still are able to generate free cash flow, that means that they're not gonna go to like a multiple of a 5 or 8 or a 10. They're still
Yeah.
gonna be at like a 20. You know, so and a 20 multiple is, like I said, from here, if you consider how much EPS growth Nvidia has over the next couple of years, right? It's not that you're just not going to see tremendous amount of gains from Nvidia where it goes from a $5 billion company to a $10 trillion company overnight anymore. It just means that it gradually has to work its way into that $5 trillion valuation, especially with autonomous cars and robots and all these other things coming online as well. Just remember, those segments are still very, very, very small compared to their data center exposure. Their data center exposure, I think, is like 90% of their operating profit. So everyone who tells me, oh, but what about robotics? What about autonomous cars? Okay, break out the numbers. Please tell me how much of the AI data center revenue that these other segments can replace. All right. So the point is, this was the article. It's called "Burning Up," warning the internet companies are running out of cash, and this was the major thing. And I think this was the most prescient part of the prescient thing. Pegasus is working with the latest public financial data, December 31st. So the table doesn't reflect the fact that Amazon early this year managed to raise 690 million in issuing convertible bonds. So the first thing is when companies start issuing convertible bonds, that's a pretty decent size that there's some problems happening, not just convertible bonds, but bonds themselves. So if you start to see the CoreWeaves of the world and the Nebiuses of the world, they start going into the debt markets, that's a problem. Do you know why that's a problem? Because that means that people don't think that their equity is worth buying into. At this point, Nvidia is still saying we'll buy equity in your company. But the day that the Nvidia and all these other guys say that, yo, we're not going to buy any more equity into your company, and they need to raise money for their new round of data centers, that money is going to come from the debt markets. And that's when, in my opinion, we need to be cautious. But
What's up? Welcome back. I saw you didn't finish the event yesterday. They signed the bill, they opened the government up, partially, anyways. But welcome back. Make sure to subscribe. I'm always on here talking about finance if you're interested in that kind of topic. If you're invested in anything, put the company that you're interested in, and I will do a quick research on that company. Let me turn my camera on. There we go. Yeah, make sure to subscribe because I always cover these types of topics.
Work, right? You have to invest the money first, and then you see the returns years later. It doesn't pay back right away.
exactly. But the problem is, if you have a depreciating asset like these GPUs and everything else, what happens when the next cycle of capex comes along? We're
Do you think that from what we saw here, it seems like the dot-com bubble was completely different than how we see the AI infrastructure and the way a lot of these companies are willing to spend a whole bunch of money. Back then, a lot of the companies that were starting up in the dot-com bubble, they weren't backed by large corporations that had billions, or actually that were trillions of dollars in market cap, like Google's in the trillions, Amazon is in the trillions of market caps, um, Amazon, Microsoft is in trillions, and Meta is in trillions. So these companies can afford to actually spend the money on AI infrastructure. Back then, when we had the dot-com bubble, we didn't have that. That didn't exist. You didn't have corporations that were making trillions, that were in the trillions of dollars in market cap, like willing to invest this money. And it's interesting that even on this list, they didn't include a company like Nvidia, who is willing to pay, whose capex is going to be really high, who focus in the GPU infrastructure. So there's a lot of differences here where a lot of people are getting scared. Oh no, it's going to be another dot-com bubble, but it's not going to be anywhere close to that. same situation. We're seeing this market is completely different, and the reality is, a lot of these companies nowadays, if you if you used any AI product, you see how useful it is. And so, because people are using it, they're able to make the money. They're able to bring in the customers, have ads on the platform, have API connectivities, like they were saying up here, and how they make a lot of their money. Boom, right here. Subscriptions, API usage, enterprise licensing. So all these things kind of create a network for all the companies to be able to make money. And so it's really impressive that a lot of people are getting scared, selling out of their stocks. But in reality, like this article, Gemini was kind of indicating that this is gonna all it's gonna do is gonna shake up all the losers, all the companies that actually don't perform well out of the market, and the ones that are gonna do well will be in the market and will continue to perform really well in the long term. So, but yeah, let's continue. Let's continue listening to what's going on here.
Upgrade cycle,
Yeah, but that means that you got to replant banana trees again.
but that's
Because-
even more demand for the neo clouds because there's not
No,
enough
that's
capacity.
demand for chips. That's not demand for the neoclouds themselves. And at the same time, you don't know
No,
if
but that's
there's
demand
actually
for
going to be demand there.
That's demand for compute capacity. And if the neoclouds have to take the chips out and replace the chips, you still need the power, the infrastructure, the electricity, all that stuff to make the chips make sense. Like my
Yeah,
point is,
but
if the AI cloud revenues that we just spent 30 minutes professing how amazing they are
Mhm.
running on AI workloads and they're running on GPUs and there's massive demand for them, that's why there's a business model for all these other AI HPC plays that are out there.
As far as I can tell right now, if let's say Google, Microsoft, Amazon, all of these guys believed in building out the infrastructure and that was going to somehow support their ROI way into the future, they would have built it out themselves and never got into the neoclouds in the first place.
I agree.
Because they're not about, hey, let's give away margin for free. They just see that this is a much lower ROI business that takes a lot more with a lot less margin. And so, you know what? Some of the excess they can outsource, but at some point they're going to bring a lot of this stuff in house.
No, 100,000% agreed. The question you said at some point, is that
Mhm.
at some point 5 years from now? Because if that's the case, these neoclouds might be up 2-3x.
But
in that
but
time.
that's what I'm trying to say, Amit. If right now the valuation is baked in for the next 5 years to be great for AI, and at any point that the picture does not develop after 2 years, this thing comes down rapidly.
No, but we just spent an hour talking about why the demand is very real. That's what I'm saying. You can't have it both ways.
No, but I'm saying right now the demand that these guys are projecting out where they need to go is extremely high based on the current valuations on these companies, right?
No,
Like
but
you look at,
if
go ahead.
Azure keeps growing at 40% on cloud, they're going to keep.
It's not 40%, it's 15%, 15 to 20%.
No, but Azure specifically is growing 40. The cloud businesses. The point is, if
No. Azure Cloud is growing 15 to 20% per year right now.
Okay, so if they keep up, which is incredible from the base they're on, if they keep up that growth rate and there's excess capacity, they're going to need help doing this, even if that's a 3 to 5 year project. And that's why they don't want to build it themselves, which makes sense. But the stocks that they're supporting and giving these deals to, those stocks probably go up if they keep getting that demand.
Yeah, go ahead, Stephen.
I wonder how long I can keep my hand up. So I'm going to help all of you out right now. I have 2 slides that I put together from Q3. Microsoft Cloud revenue for Q3 reached 42.4 billion, 20% year over year. Key driver was Azure and other cloud services, which saw revenue growth accelerate to 40% year over
That
year.
was my 40% number. Yeah.
Intelligent Cloud division is now operating at 123 billion annual run rate with 13.4 in operating income for the quarter. Google, which we went over before, revenue accelerated and grew 34% year over year. Profitability soared with Google Cloud posting a record of 3.6 billion in operating income, 85% jump from the prior year. Now we go to Amazon and Meta.
No, but Steve, before you continue, because all these cloud numbers everyone knows, the question we're having right here is, does that mean that these cloud numbers you're showing us, is that good for the neo clouds is the question. Or are those in a bubble? I think that's kind of the conversation.
These numbers don't matter for the neo clouds one bit.
No, I think they really do. Because if Azure is growing at 40% year over year, they need to outsource the capacity for the AI workloads that are allowing them to grow like that, which is why they're getting Nebius.
The numbers that matter for the neo clouds are the backlog for these companies, not these numbers.
Yes.
That's what matters for the neo clouds.
Yeah, but the backlog eventually translates into revenue.
Right. But these numbers support the backlog.
No, I get it. But my point, I think we're mincing words here. My point is if all these cloud divisions keep growing the way they're growing.
Yes, ultimately it is bullish for everybody because you look at Google, backlog grew to 155 billion. Now you go to Amazon, AWS is 132 billion run rate. And operating income was 11.4 billion, and revenue grew 20% year over year to 33 billion. And then Meta, this is a clear use case of AI. AI-driven revenue increased 26.2% year over year. And AI-driven engagement, Reels and AI-driven content discovery engine achieved 50 billion annual run rate. Those Zuck breaks out, and that is a clear use case of AI showing that even outside of the data centers, AI is real on an enterprise level for things other than business. So,
Steve, do you think that the cloud divisions of these companies, even Instagram Reels, means they need help? And even like Microsoft doesn't give a shit about building all these data centers, which is why they're giving Nebius $20 billion. But if there's so much demand over the next 5 years, 10 years, 3 years, whatever it is, and they need help, are they going to keep giving the Nebius, the CoreWeaves, the Irens, the deals that they're getting? And if they are,
as long as they need more, they're going to build as much as they need and sub out as many contracts as they need to buy their compute, as long as it works in their profit model.
So then are those attractive?
They're subcontractors.
The question,
they're subcontractors. As soon as the demand falls significantly, that the big dogs can handle all the volume. Either they grow their capacity to handle it, or the demand shrinks, and now it's back in their wheelhouse. All these other companies that were subcontractors, they're going to wither and die on the vine.
And keep in mind, the real question that matters is Nebius and CoreWeave. They can expand their data centers, and Microsoft can keep giving them contracts. They have to tap the debt markets to build out. So the $1 million question is, can they generate enough profitability after that's done to pay back the debt and turn a profit for their shareholders? That's the $1 million question. It's not whether this
or
is
they just get bought by one of these companies later on.
And here's the one thing that I think Nebius has, maybe even CoreWeave to a certain degree, that a lot of these other neo clouds don't. And you know what that is? Their goal, and Nebius is very smart to do this, their goal is not just to be a subcontractor. Their goal is to actually be a cloud provider. So it's not just, hey, we're going to be Amazon's little brother and AWS's little brother or Microsoft's little brother. Their ambition is, we're going to have our own cloud products and services which companies can come to and contract with us. So, and that is smart because that's much higher margin. So unlike the other guys, if you were to tell me Nebius is down 60, 70% because this whole AI cloud data center play got washed up and this thing down, I'll be the first one to buy Nebius hand over fist. But the other ones, like Iren, I'm not even Iren. Let me just take that back, because Iren does do Bitcoin and all this other stuff. But some of the other ones, like Bitfarms and all this other stuff, I'll stay away from those.
Yeah, I don't think they're investable. I admire them for saying, hey, look, this is an opportunity for us. We need to pivot our entire business right now. That's an amazing executive decision, huge risk taking. They paved the path, and then it looks bubble-ish because everybody else followed them. But leading in that and saying, we've been doing this for years. This is our wheelhouse. We're putting this down, and we're going to go do this. That took a lot of guts, and I really commend their executive team for doing that. Will I buy it? Nope.
You're talking about the Bitcoin miners, right, Doug?
Yeah. Nope, not buying it.
Yeah.
Although somebody's got to mine the Bitcoin at some point.
Do we even care about Bitcoin anymore?
No, not really.
Well,
But
I know there's some Bitcoin bears here, but look, I mean, it's not like that is going to zero and that ecosystem is going to stop tomorrow, right? But somebody has to be mining the Bitcoin. I'm been curious about how that is happening, continuing to happen in the background. Are these companies still mining and they're just adding on
Good
all
question.
these
All right.
additional services?
There's
My
a little
understanding is about 95% of IREN's revenue is still Bitcoin related.
So is their net income, I believe. Yeah. Look, I agree with Chris. I think the neo clouds are investable if you think there is a trajectory for demand from the hyperscalers to continue onto the little clouds because they need help because there's just that much demand. And if you think those clouds are diversifying the business model and not taking on as much debt. If they aren't taking on that much debt, they have a diverse business model. It's not just cloud. They're trying to internally build their own things. And the deals they're getting from the hyperscalers are, the trajectory on them is very long. I think they're probably higher in a couple of years. But if not, then they fall back down easily.
So there's one thing that I did a few days ago. I uploaded about maybe like 10, 20 videos and a whole bunch of data on these neo clouds, and I ran it through Notebook LM. I want you guys to watch it, and I think this is a really cool thing to see because I don't know if anyone here in the chat saw the VG thing, but the neo cloud one is actually a really good thesis. Do you want to check it out real quick? It's only a few minutes.
Can we show this?
Yeah. All right. So
Amit, I'm gonna look to you. Can we show this?
Yeah. But how long is it?
8 minutes.
Okay. Do we
It's
want
not
to
that
sit
long.
here and watch
Yeah,
it for 8
we
minutes?
could trust me. It's very eye opening.
Play 1 minute of it. I'm
Talking
gonna
about
say.
the
I'll
AI.
leave it to Steve. It's his stream.
You know, the
Yeah.
real story, the one that might be even bigger, isn't just about the AI models themselves. It's about the absolute explosion in the digital plumbing that makes it all work. And the companies building this new foundation, well, they're at the center of a really fascinating paradox. To get a sense of just how massive this boom is, just look at this number, almost $1.9 billion. That's the estimated revenue for a single company, CoreWeave, just for 2024. Now, what's truly staggering is that just 2 years ago in 2022, their revenue was only 16 million. That's not just growth, it's like a supernova. And believe me, they are not alone. You know the old saying about a gold rush, right? Don't dig for gold, sell the picks and shovels. Well, that is exactly what these companies, often called neoclouds, are doing. While all the big AI labs get the flashy headlines, the neoclouds are the ones quietly providing the raw horsepower, all those specialized GPUs that makes any of it possible. They are the essential but hidden engines of this whole thing. And here we get to the paradox. For all this incredible mind bending growth and all the hype, a really critical question is starting to bubble up. Is this foundation they're building actually solid? Or is this entire multi billion-dollar industry built on a temporary market fluke that could just vanish as quickly as it appeared? So let's start where these stories always start. Follow the money. This completely unprecedented growth has led to some absolutely sky-high, stratospheric valuations. I mean, the market isn't just pricing these companies as successful businesses, it's pricing them like they're the next generation of untouchable tech giants. Just take a look at these numbers. You've got CoreWeave, Lambda, Crusoe. They're all trading at around 10 to 12 times their annual revenue. Now, in the world of finance, that's what's known as a platform multiple. It's the kind of premium price tag you'd give to a dominant high margin software company, not a business that has to physically buy billions and billions of dollars worth of hardware. So, what's the catch here? What are investors really pouring billions into? Well, they're capital intensive businesses. They're often still losing money. I mean, CoreWave lost over $800 million in 2024 and is
Chris,
sitting
can you link this?
and they are dangerously dependent on just one or two massive customers. It really highlights this huge disconnect between.
What did you ask, Stephen?
Is there a way for you to link this video?
Yeah.
Right. Link it in the chat.
Well, I can't. I actually download. I have to actually. This is not on YouTube. This is something that I had to download. So.
Okay.
Upload it to your channel.
Yes. Not the thing is, some of the numbers on here they're incorrect. See, this is. By the way, if anyone wants to know, this came from AI. Okay, AI did all the work behind this. I did nothing. No graphics. No nothing. I just uploaded a bunch of stuff and said, "Here you go, AI. Create a video that does the explanation on what's going on with the neoclouds." And this
was made on Notebook.
Yeah.
Dude, Notebook LM is amazing.
Yeah. Oh yeah.
Especially when you pay for the bigger package, it's freaking amazing.
Oh, dude, it does amazing work. The
Yeah.
only challenge is it still hallucinates a lot. A lot of the stuff that the core concepts of this video are correct, but there are numbers in there that are not correct because what it did was it used numbers that I fed it, but it looked at the data from 2024 and not 2025.
This is why we need
And it
more
was-
GPUs. You just made us listen to some shit
More
that's not even
compute.
right.
I mean, you didn't even get to the like finish of this thing, but whatever, you know.
So we got
Did you weave in? Did you weave it in?
Huh?
Do you weave it in?
Hey, that's some mid-level humor right there. Y'all should all be
Yeah.
cracking up, especially this guy in the top middle.
Love it. All right, so we got 3 questions we need to answer. First one, thank you for the super chat. Does everybody think the market will crash badly next year? Wouldn't Powell being removed in QT ending be bullish? Me personally, I don't believe the market is going to crash next year. I'm not saying that. Amit, what do you think?
No, I don't think we get some 2022 type of year next year.
Chris?
I think we get a V-shaped bottom and recovery like we did this year. So there's going to be a massive volatility spike to the downside. Everything is going to go, oh my God, the world is falling apart, and then we'll recover.
Austin?
I could see some chop. I really like Dan Ives' analogy of being at the party. You're going to have some glass break on the dance floor. Party continues.
I like it. Dougie?
It'll trade sideways, but overall the bull run is still on. All these companies are still making money. Margins are still expanding. And maybe next year we'll have monetary policy finally coincide with the economic theory of the chief executive and the rest of the treasury. So that might actually work together instead of working at cross purposes.
So 5 of us pretty much agreeing. Pretty great.
Yeah, I see inflation coming down significantly because housing is going to be one of the biggest deflationary things next year. Like, I don't know if you guys are looking at rental data. Rental data is collapsing all over the country right now. Home prices, housing sales data is crashing right now. So, like I said, I think there's going to be a giant re-rating of shelter lower. Shelter, I think right now the current inflation rate is like 3 point something, but it's like backwards looking. If you're looking forwards on a forwards basis, I think we're already at 2% on the shelter, like on a forward basis. So when you look at like shelter month over month.
Assuming Ethereum fulfills its payment rails vision, how much is already priced in today? Speculation on this being achieved drives current speculative value. So why do we presume perpetual upside? Amit?
I don't even hear the question, to be honest. How much is already priced speculation on being achieved drives current speculative? I have no idea how much was priced in today, but I would say it's not enough. I mean, Larry Fink is saying $4.5 trillion gets tokenized. Tom Lee is talking about 50% of the entire asset chain that runs on traditional payment rails through Wall Street gets tokenized. Vlad says it takes over the entire system. So I don't know how much is priced in, but I would say it's not enough if you believe that it is going to be bigger in the future.
Yeah, I don't think that we have enough information to make any type of prediction accurately. We need to see what happens with stablecoin and how much utilization there is over the next couple of years. Chris, Austin, or Dougie, you have any feelings on this one?
I think stablecoins, as long as that legislation gets done before the midterms, it's going to be very positive. So I'm in agreement that stablecoins is where you want to look for value, because I think once there are just so many benefits to stablecoins that now it's getting institutional support. And now that you have government institutions lined up behind it, there's big money being spent on the whole ecosystem. Whether you look at Fiserv, you look at JP Morgan Chase. I mean, you got the biggest crypto bear on the entire street, Jamie Dimon, flipping the script. I mean, if that's not any indicator of where we're headed with regards to stablecoins, I don't know what to tell you. I mean, you literally turned Jamie Dimon into a believer. You know, Jamie Dimon is launching his own stablecoin, by the way.
Yeah, that plus Circle was down yesterday, by the way. So
Austin or Dougie, do you follow Ethereum?
Yes.
How do you feel about this?
Can you share my chart?
Yes, I can.
This should tell you all you need to know, folks. Yes, Ethereum has a whole lot of room to run. Folks who know me know that I believe Bitcoin is king. It's going to be the king for a long time. I know people in the chat and people, the hosts, don't agree with me on that. But any way you look at it, Ethereum is going to recapture some of its value relative to Bitcoin alone. So, and that is not going to be due to Bitcoin dropping down to 60K. So, yeah, Ethereum is not fully priced in. It has a lot of room to run. It has lots of functionality ahead of it with stablecoins and stablecoin legislation. Yes, Solana is going to eat some of that, but Ethereum has its place.
Austin?
As far as adoption, I think we're really, really early on, especially working in financial services. You just don't see it actually being used that much yet. So as far as the priced in part, I think if you get more adoption, I can't see it being priced in already. But that said, I'm kind of neutral on Ethereum itself. I just kind of want to wait and see.
Okay. Chef Mike is with us. Gotta get Chef Mike on with Chef Paul to have a duel of the steaks or something. That would be interesting. Even with the .com bubble, the world still runs online. We don't know how AI will look in the future, but these companies will still be part of it. Agree 100%. And then Carl, thank you very much. 2016 to 2018, Microsoft CapEx up, revenue on invested capital down, scale dollar. Yeah, I mean, we all know how that ended up. So
Wait, here's the rental data for the shelter thing really quickly. Look at this trajectory. This is from CoStar. Apartment monthly rental prices went from 1.5% to now 0.8%. So literally we're in massive amounts of deflation going forward with regard to shelter. And shelter, I think, is about 30 to 35% of the CPI. So, and by the way, next year, apparently, I didn't know this, but the Trump administration just got a huge infusion of money for ICE and border protection and everything. So they're saying that the ramp up in deportation is actually going to grow next year. I don't know if anyone's heard of that. So you think that we've seen all these deportations now, you just wait until next year. And I know some people are going to say, well, illegals don't buy houses, but they do rent houses from people that own houses. So if all of those people are getting removed, all of these renters are now going to be gone. So either the prices of the rents are going to come down for a lot of property owners, or they're going to put those homes on the market for sale, which is going to increase the amount of active inventory out there. So all of those things are going to add to downward pressure on shelter.
We're already seeing it in my local neighborhood, local zip code. My house has gone down at maybe 30% in the last 9 months on the, just the Zillow estimates or whatever. And, on the other hand, the county is not reducing the assessment of my home by 30%. That's going to go up 10.
yeah, why would
Because
that?
Yeah,
because they got used to.
So that's something to consider. Is if we have a real big pullback in housing valuations, then we might see that in local taxes.
See, the
I don't know if
problem
we've
is-
ever seen. Oh, go ahead, Chris.
No, you go ahead, Austin. It's fine.
I don't think we've ever seen quite a unique setup here where you've got lots of people who locked in rates so low, and then you might have this portable mortgage wrench thrown into the situation at the same time as 50-year mortgages. And FHA is, sort of pointing their finger and telling all the builders that they need to build on all these vacant lots, which is going to add to supply. And as Chris, you pointed out, you could have large number of deportations. It's a really interesting soup, and it's kind of hard to see where it all goes.
Yeah, the other thing is a lot of local governments they've been on a hiring spree for the last 4 or 5 years. So if property assessments go down, remember a lot of localities they generate at the county level, they generate their revenue from property taxes. So if your budget is based on property taxes from 2 3 years ago when property assessments were 20 30% higher, you got a problem. Now you all of a sudden you've got to lay off staff. Now what does that do? That increases unemployment at the local county and state level, right? Which is once again going to slow the economy down. So, like I said, we're in a cycle, I think, of a downward move in inflation. And I think we get massive amounts of disinflation in the next couple of years. I think Stephen Moran is absolutely correct. I think the current governors that are being extra cautious, they're letting their own internal biases guide their cautiousness. Like right now, with Bostic came out, Bostic was like, "Oh yeah, no, I think inflation." And Kashkari came out, and I'm looking at them. I'm like, Open up Google, just type in, hey, what's going on with unemployment? What's going on with shelter?" You don't need to wait for BLS data. Dude, there's so many other sources that you can get data right now to tell you that, hey, inflation is coming down. Yes, are there some short-term spikes because of what we saw with natural gas? But those are like seasonal events, So I don't know. I hope they make the right move and they actually cut in December. They really need to cut.
I'll say anecdotally, I've got a house on the market, and with 30-year fixed still at 6%, I've got one person even looking at the house. Okay, and this is Phoenix, so one of the hotter markets. So maybe it's it is an anecdote, so take it for what you will. But I got 6 or 7 offers just from investors that were lowball garbage offers that no one would even take. Title doesn't even transfer. Just one actual family who looked at the house. So it's really, really slow. And I just wonder what happens if you shake the snow globe, what sort of unravels there, especially with the portable mortgages. That's really going to unlock lots of volume in that sector.
So the question is, you can't really do a portable mortgage on Bitcoin just dropped to 97.
Yeah, Steve, share my screen. That is taking. You know what's happening? The South Koreans are waking up and they're like, "Fuck this shit, dude!" They are getting out of it.
Why are you using Webull, Amit? Why are you using Webull?
Dude, Legend has crashed 5 times, and I know Chris loves hearing this. Right, it crashes almost every day. And I'm just like, I can't keep, and it doesn't show the after hours move. It's the stuff I need them to change. They haven't changed.
You know what doesn't crash? TradingView.
Webull doesn't crash either. Webull always gets updates. It's
well,
nice.
The stock crashes.
You didn't have to go there, bro. You didn't have to go there.
You remember a couple of years ago when I was sending you Bitcoin charts on the regular all the time? This was that chart. I honestly haven't pulled this up. Look how well this played out. This orange line was from back then when I was sending you these charts, what was that, 23? Look how well this played out.
No, dude.
So Doug, you just said Bitcoin is king. Are you buying this?
I got to do a little more TA on that, but probably not. RSI is still above 40. Let's wait till it gets to 25.
I should have been buying when you were.
This yellow line right here, it will not go below this number. 66,783. That was the price on election day.
The thing is, Bitcoin is taking everything down with it. I'm looking at everything right now. I don't. Okay, so maybe we should end on.
This is perfect setup, though. I mean, you've seen enough with Jason now on TA. I mean, look, this was a max support. Look at all this chop back here. Okay, it broke that. It broke this support over here. Now it's going to come down. Now we're going to test these levels. We're going to test 85, 70. What's this? Maybe 80-ish right in here. I mean, we're going to test that, but we're not going below this. But I mean, you're going to keep riding this trend. So, I mean, if you want to sell this trend line, look how far back this trend line goes.
Well, here's the question I think we should end on. What does everyone think happens tomorrow? Obviously, futures are ugly right now, but any predictions on how
I'm not looking at my port tomorrow.
I mean, this could be a fake out right now, and then you wake up and pre-market's different, or this shit. Because again, what saved us last Friday was the shutdown headline. That's the only thing that reversed it and gave us a good weekend.
Guess
Trump actually,
guess who reports on Wednesday?
Nvidia.
that's fair, but
Jensen will save the market.
well, this headline, I think if things get bad tomorrow, I am not ruling out a Trump tweet, because if you share my screen right here, New York Times is reporting that Trump is getting ready to seriously lower tariffs on food. Markets actually, this was at 6:05. Markets actually started moving a bit when this headline came out, because there was something good they could latch onto.
Well, crypto didn't like it.
I mean, I don't know what's the catalyst tomorrow to maybe
There
reverse.
is one thing that I'm super long on in this market, and that is the funniest memes when the market goes down. Check this one out right here. Why did I buy Nebius at 86 in October? No, I ain't buying that shit.
1 month later.
No, but that's all of us, bro. That's like legit all of us on these names.
But that's
No, I'm not
evidence
buying
that you
that
know we're
pilot
not in a bubble. That's evidence that we're not in a bubble, because people are actually reacting correctly to pricing, and they're rethinking their thesis and saying, is this a sustainable business model?
So this is what I'm going to say. Today's the 13th. Tomorrow's the 14th. Guess what happens over the weekend? You got the 15th. So people are either buying the S&P and total market funds tomorrow
That's
or
true.
Monday.
That's true.
A lot of money's flowing in. And this is what's crazy. Unless you're retired and you have to pull money out over the next couple of days, you should want the market to freaking dip tomorrow and Monday so you can just buy more in your retirement accounts when you're putting money in. I mean, a couple of days stretch of bad days should not matter to anybody unless you're a day trader.
It
Very
shouldn't. It shouldn't, but when it drops, that's when people start doubting the entire trajectory of like
Yeah,
America.
that's
even though
people
it's
that are not
overly
seasoned
dramatic.
investors.
Agreed. That's overly dramatic, of
One,
course.
one thing I am worried about, Amit, and this actually seems like it might be right up Chris's alley too, is the wealth effect
Yeah.
at this time of year. Like people should be going out to eat more. They should be buying gifts and stuff. And maybe the top 25-30% are going to be fine. Like, my sister and her family, they're going to Disney World for Thanksgiving. They're fine. But, the wealth effect for the average American, is that going to start feeling crunched? Maybe not, because they don't own securities. So maybe they don't care at all. But
Look, the big problem right now is who's leveraged and who's not, who has liquidity and who's not, how many people are buying on margin. I mean, I still think there's too many people utilizing margin, and I'll stand by that for a long time.
Well, it's at 1.3 trillion, the debt.
It's crazy. It's crazy. And when you get down days and you're on margin, it makes the effect so much more dramatic. So people who aren't on margin don't care.
Do you think this is Q4 2018 vibes or not like that? Because that's what I've heard.
I have a spicy take here, actually, if you guys want to hear it.
Go for it.
Yeah, go for it.
This is the market pricing in who's the all-in guy, their science nerd?
Freeberg.
Freeberg. This is them pricing in Freeberg's thesis of socialism coming for America starting to take hold. This is the market saying, wait a minute, we have a giant segment of not just the current population, but the future population that is going to be coming after the way markets have worked. And so Nancy Pelosi resigning, and you can say what you like about her politics or whatever, I think we can all agree she was aligned with capitalists in the market. And she was the last vestige. She's the last Democrat holding the balloon of capitalism, as near as I can tell. So half of the country's leadership is taking a hard turn left towards socialism, and I don't see that pivoting back anytime soon. I mean, the other side is nobody's going back towards the middle here. So I think that is getting priced in when the market is realizing there is a fundamental sea change going on with half the leadership of the country, to the point where they're willing to shut down the government for 40-something days just so that they don't agree on something when it was their budget to begin with.
I'm not sure that an election in a really blue area like New York City is reflective of what could happen in, say, like a general election for the president, because you're going to have more moderating effects and you have to win those flyover states to get your electoral votes. So I don't know if Mamdani actually is now the face of the party. Maybe he is, and I've missed it. But I don't feel that, other than a lot of the loudest Democrats, that that's the new future. What do you guys
It-
think?
but it's a symbol that more people don't believe the system works for them. And when you see what's happening with all the layoffs, it could become a big problem. I think we're very early in the cycle. I can't handicap which way it's going to go. What I can say is that the Fed needs to cut rates. People need to stop worrying about inflation. Whether you have 3% or 4% inflation does not matter one fucking bit. If you pay $103 or $104 for groceries, it does not matter. What matters is that we have an environment where entrepreneurship can work, small businesses can borrow, and regular businesses can borrow to expand, because we have to make sure that there's enough jobs out there, especially in an environment where large companies are cutting. So the only way you get that is is being able to access the capital markets. So I would rather have a little bit higher inflation, if that's even a thing. I don't believe inflation's going up, but if the trade-off on the curve is more inflation for lower rates, I'll take it, because that means that there's an opportunity for more jobs for Americans. And that will ultimately fix everything, because we're
Yeah.
still a free market society. And if there's a demand for services or goods, somebody's going to step in to fill the void.
I agree. And I just want to, like, the chat is having, obviously I made a bit of a political statement. Chat is having its typical meltdown. And what I want to say is, I think what we're seeing is the market reacting to it, not my personal political opinion. But I think that is something the market.
Dude, but I'm seeing comments saying that take is fucking stupid. How do you defend that take, Dougie? These comments are roasting you.
I mean,
Well, I'm saying look at all the red. That's my evidence.
well, I
If
mean,
airports are green, then I'm wrong.
obviously the largest city in the country just went a certain way. So you got to take it somewhat seriously. Is it going to happen more? Who knows? But look, this is a clear indication that what these people have been taught their whole life: go to school, take out student debt, go get a job, and then they're living in debt. Obviously, they feel like the system's not working for them. And do they have a point? Absolutely.
Well, here's another way to prove Doug's argument. What happens when a politician says, if you vote for me, I will make sure AI doesn't take your job? Like, how are we not underestimating the fact that that could happen if
You're
600,000
making me want to play this video so bad. I'm going to link it. I may stay up and watch it with whoever wants to stay. Barry Sternlich discusses the actual economics of running businesses in New York. I did not realize the numbers in his hotels. He actually said that he has to close banquet halls because I don't want to take him out of context. I'd rather just play the video. But he said he has people working part-time jobs that are part of the union that are getting paid 250 grand a year. And it's just
Yeah,
the
that's
unit
right.
economics just don't work.
Yeah, that's New York City, man. Trust me, I've seen that too. New York City, like the amount of special interests that are all over New York City. You wonder why the Second Avenue subway cost literally for a few miles cost the amount that it did.
Yeah, I don't know if the market is pricing it in the way Doug says, but the idea that the market could price it in is not irrational at all. Because if there is any hint of socialism meaningfully taking over, or at least the general populace leaning towards that direction, and just the idea of big businesses not being valued in this country because of potentially AI taking your jobs and a Mamdani wins the presidency, that is something the markets will have to discount, and they could in the future.
Yeah, I think
Mamdani can't become president.
We're
by the way.
shifting. We're seeing the populism, which was aligned with Trump and the Republicans last time. Now the populism shift is going to be anti-AI, and that's going to be left, and that's going to bring all of the socialists who now control the party with it, because the old guard that I would call, the Democrats I grew up with, the Clinton Democrats, the Obama Democrats, they're all gone. It's now the AOCs and the Bernie Sanders of the world.
It's a real thing.
We need to make sure that there's jobs for Americans. And if AI and robotics are coming for all jobs, our elected officials need to figure out what we're going to do, because you can't have a society that doesn't have any money. Period. Full stop. Like, you have to figure something out. Whether Andrew Yang was correct in 2016, talking about by 2040 you need your universal based income, whether you're going to put some type of tax on these things to fund everybody who doesn't have a job, I have no idea what the answer is. But these are the questions that they should be working on right now instead of squabbling about a shutdown.
I'm sorry, dude. I can't agree with universal basic income. I think that there's going to always be a need and a purpose for people. And the fact that like people can get free housing, get free food, get free welfare. I mean, bro, how many free programs are going to be out there? I'm sorry. I'm okay with helping people temporarily while they can get back on their feet. But we cannot turn society into, hey, you're born, here you go, here's free money.
Chris, if there's no jobs,
Chris, I'm not saying we should. All I'm saying is that if our jobs go away, if the jobs go away because AI and robotics take them, they're going to have to figure out a way for people to live.
There's plenty of other jobs that'll come around.
No, but
This is
Chris,
like,
if there is no jobs, what do you think the government? They're gonna have to give money. They
There's
gave
gonna
money
be
in
plenty of
COVID.
jobs.
Like,
there's going to be plenty of jobs.
There's no
I don't
such
think
thing as money if there's no jobs, because jobs are how you take your labor, your sweat equity, and you turn that into, okay, well, if I'm a farmer and I'm growing potatoes, well, I don't want to eat just potatoes. I want to eat a steak. Well, I'm going to sell some potatoes, get some money, and then I'm going to go buy a cow or something with it. Okay, that's what the money does. You can't just like print money out of nowhere and give it to everybody, because there's no sweat equity that's gone into it. So the value goes to zero, and then we're living in Zimbabwe and we're literally lighting money on fire to warm our homes.
I have a cousin. He's been out of work for the last 5 years. Okay. I was talking to him. I was like, like, if you need anything, let me know. I'll help you out where you can, whatever. And I was like, like, where have you been looking? Right. He's got a master's degree, really smart guy. He's been working for like the last 20 years. He says, I've been looking for the last 5 months and I can't find anything. And I said, well, have you tried applying to like the local Kroger? Because I saw help wanted sign there. He's like, no, that's beneath me. I'm not going to do that. And I was like, bro, you're like in a really bad place financially. You're running on credit cards right now. Like, I'll help you, but I'm not going to be able to sustain you for the rest of my life. That's just not how it works, right? And I think a lot of people are going to have to come to the conclusion that whatever they went to school for, if that's not what is necessary for society and there are other job opportunities out there, you can go work there. You can do that temporarily while you're looking for something else. You don't need to just say, oh yeah, woe is me, let me sit down and do it. You can go and learn other trades, learn other skills. I think a lot of people need to wake up to that idea. And if you think that, oh yeah, you know what, like, we need to somehow just give people money, I don't agree with that. I think that there are jobs all over the place, but people do not want to look. They feel that a lot of jobs are beneath them. If you've ever seen Mike Rowe, when he goes to like a lot of jobs, it might not be the ideal job, and you're never going to find like, oh my God, I love this job, that's why I'm working. Bro,
Chris,
job is the job.
If you've worked at Amazon for 30 years and now your job is gone, what do you tell that person? You can't just tell them to go find a new, like, if they've been in a warehouse their whole life and the robots have taken over the warehouses, like,
so it goes deeper. It goes a little bit deeper, because I agree with Chris to a degree, but at the same time, in this scenario, and I'm not saying that this is going to happen next year or the year after, but we have to at least be willing to accept the fact that over the next 10 to 15 years, there's going to be such a fundamental shift between robotics and AI that a lot, if not all, fast food workers will be robotics. That Uber and trucking industry is going to be full self-driving. I mean, that is a reality that is a high probability over a 10 to 15 year time frame. There is also a probability that I will not be using my accountant, and that will all be automated. There are a lot of things that can happen over that period. Now, maybe new jobs will spurn, but there's also a flip side that they won't. And I don't know what's going to happen, but when you have the combination of robotics and AI at the point that we do, this is going to be much different than SaaS and cloud computing that reshaped HR and finance departments.
Well,
So,
here's a question, Stephen. Right now, you work in an office level job, white collar. If you lost your job today, you couldn't find a job for the next, let's say, 3 months, and you needed to pay your bills. I offered you a job to clean toilets. Would you do it?
have to.
I would too.
Period. Period.
I
You
would
have
too.
to. Yes.
I don't think that analogy, dude. If
But
you're
that's
if you're
not
if that's not if you're 55 and you're raising a family of 4 and your job gets taken by a robot, how do you start over life at 55? I mean, theoretically you could clean toilets, yeah, but then the robots are probably doing that commoditized
so,
job.
but once again, I agree with Chris.
Over
What
as
you have to do to survive. But at the same time, my point is more of a 10 or 15 year thing, not a 3 or 6 month thing, where at some point, a lot of these jobs just aren't going to exist. We're seeing it with coding right now. We're seeing it with low
I'm
and mid-level
sorry.
coders.
I'm sorry, dude. I disagree. Like right now, if I learned
Chris,
CS,
I'm not saying right now.
right.
I'm
No,
not
no, I'm
saying
saying
right now.
even in the future, like let's say I have a job that got outsourced to some robot, right?
Right.
I would do the job that I didn't like temporarily, and I would retrain myself to a job that is necessary. You don't think that we're going to need robotics engineers in the future? If you were telling me, Chris, coding, there's no more coding jobs, I'd be like, okay, fine. I'll go find a job as an engineer. I'll go work. I'll go to night school if I have to go to night school. I'll do what I have to do
Bro,
to
but you
get
need to
and
eat.
retrain
You need
myself.
to, you need to eat
Mechanical
during that
engineers are
time.
not being replaced by AI.
Yeah,
No, but
there's a
during
lot of
that during
jobs.
during that time of retraining, you still need to pay your bills and eat food.
No,
And if you don't have a
and
job,
I'm okay with that, where the government does step in temporarily to help, but you cannot create a system where it's just like, yeah, go ahead, just sit on your ass all day. Here's some UBI and enjoy the rest of your life. Here's free housing. Here's free food. Here's some money for you to spend on
Because
GTA
the
when it comes out.
because the UBI becomes zero. If everyone
Yeah.
has it, it's worthless.
It's a band-aid, not a
Working for
solution.
air.
no,
Yeah.
I agree with that. I agree with that. And obviously, money gets debased and currency gets debased if we keep printing it. But the point is, at that moment where a 55-year-old person needs to retrain their entire life, they still need to eat food, right? So maybe the government doesn't give them a stimulus check, but they give them food. Like the point is, something has to
Snap.
intervene at that point, right?
We have it. It's called SNAP.
No, I get it, but like we're taking, if we have mass unemployment, it's got to be deeper than just SNAP benefits, right? Like Chris, realistically, if 5 million people in America got replaced by robots tomorrow, you don't think the government steps in, even if it's
The
conditional?
government's job would be to retrain the existing population, support that to the next thing that actually is required. There is a shortage of plumbers, there's a shortage of roofers, there's a shortage of electricians. If you go outside of the nice, comfortable white collar bubble, there are tons of jobs that are currently out there that no one wants to. You can be a journeyman. There's lineman jobs. There's literally garbage collecting jobs. You could be a cop. You could be a fireman. You could work
So
as a
Greg,
nurse. Do you know how much
Cops
of
are
a
hiring.
big of a do you know how
ICE
big
is
of a
hiring, I
shortage
heard.
we got a big shortage right now in hospital systems as lab techs, as radiology techs. But here's the thing: you have to give people the incentive to retrain themselves if their current job gets replaced by either robots or automation or everything else. I
Yeah.
think that
Sitting in
jobs
front of a
evolve over
computer,
time.
Typing your data into a spreadsheet, that job is going away.
Right.
That's
But that doesn't mean that there's other jobs that won't be created.
but Chris, in all seriousness, over the next 10 to 15 years, you don't think that some of those things that you listed are going to be replaced by robotics?
I'm sure that whatever gets replaced by robotics, there are other jobs out there that people are going to have to retool themselves and get into another career. And look, it's not going to be easy. I'm not trying to say like, yeah, guess what? You go to a couple of classes in night school a week and everything's going to be fixed. Your life is not going to be fixed. But here's the thing: the answer isn't my life is over, let me just sit on my ass for the rest of my life. The answer is pick yourself up, figure out what the next step is, and take every day one day at a time and figure out. And you know what? I have been in a position where I was at the lowest of lows and I've been at the highest of highs. The one thing I'll tell you: never quit. You never just give up and say, you know what? And here's the thing: when the government says, don't worry, here's money, here's food, here's shelter, you know what that does to the human soul? It kills it. Because any sort of like like, what is it called? Like satisfaction in life goes away. And then what happens? You become dependent of the state.
That's the downstream on all the UBI pilot programs as well. Like I'm Googling stuff and everything says, oh yeah, blah, blah, blah. Their lives, they experience less mental strain than the control group, blah, blah, blah. But yeah, that's the first like 2 months. The long-term effects of UBI are seriously detrimental to the long-term outcomes for people's lives.
Yeah, and society in general.
Because they start living on that meager bit they get, and they lose their initiative, they lose their drive.
Yeah. By the way, I'm not a Marine. Don't call me a Marine. I was a soldier. Marines are different. But I'm telling you, all these
interesting.
Yeah.
I think it's interesting that everyone focuses on the job loss, because that is like the scary part that affects people. But I think on the other end of that is the productivity side. So if you have so much productivity coming from this really powerful technology, then doesn't that mean that we're going to get lots of GDP growth, and that there's going to be a boom in assets and ROI and all these different things? So, that's why I like to hold assets, because you're going to get left behind if you're the one caught out without the job. So I agree with Chris here. You can retool and get back in the game, but there's a possibility that you can get left in the dust if you don't.
I mean, like I said, I grew up in a different mindset, that my job was always to figure out what the next step is and keep retooling myself, reinvesting myself to the point where I'm going to go with what society needs. I'm not going to be like the type of guy that's the problem with these Mamdani characters, where they just say, no, it's not the government. It's not your fault. It's always the government's fault. No, I'm sorry. There are times where people just have to say, you know what? I'll take accountability. I'm in a job that is getting outsourced. I'm not finding the right job. I need to find something that's in demand. Okay. I have 5 jobs lined. Like, I have 5 jobs in my brain. If I lost my job today, I didn't have any money whatsoever, I would either become a locksmith, I would become an electrician, I would become a plumber. Why? Because those jobs can't be taken over by AI. They need specialized skills, and they pay really good money.
I would become a comedian.
You'd be a terrible comedian.
Be on Universal Basic Income real quick.
Yeah, man. I mean, I see why Amit supports UBI now.
Okay, we got to end it there.
By the way,
that's the best way to end it. There's no other way we could. That was good.
My dad. He had a master's degree in chemistry and everything else, and he worked at a pharmaceutical company. But do you know where he worked right before that? In Farmingdale at 7-Eleven. In the morning time, I would go with him sometimes because there was no babysitting. So I would go with him in the morning and help him make papers. Do you know, back in the day when you got papers delivered to the newsstands, to the stores, like everything, they didn't just come. You had to take all the flyers.
Yeah, you got to put the sections together.
Yeah, you had to put all the sections together.
Why don't we start a 7-Eleven? Why don't we fulfill the Indian American dream? And
my brother has a gas station, bro. If you want that experience, that life for a couple of weeks, let me know.
First of all, my dad, I was basically in the liquor store for like 15 years. So I experienced that life. I feel like we need to live that life before.
Nah, bro. 7 days a week, 18 hours a day.
I know, it was bad. I didn't see my dad growing up. I didn't see him. He was every time you got to worry about this one dude that walks in with a gun that's going to stick you up. I mean, dude, it's not easy. My grandpa got stuck up 3 times, and he doesn't speak English, and he was cheap as hell. So the guy put the gun in front of him, and he said, "Open the register." First of all, he doesn't understand what "open the register" means. Second of all, he's not afraid of anybody. So he's like, he would start cursing the guy out. I remember one time there was a guy who bought a cigarette. My grandpa and me were there, and he wanted a light. He just wanted a little bit of a light on the cigarette. And my grandpa was like, "No, screw you. You got to pay for the matches." And he started cursing. He jumps over the counter, and I'm over here watching. I run to my grandpa. He's about to punch my grandpa. I was like, "Bro, here, take the lighter. Take the fucking lighter." And it was just like those experiences happen, and it was crazy.
My dad's been stuck up. He got pistol whipped. He's got literally like a giant gash right here from the time. I mean, look, you think, oh, it's just a retail store clerk, bro. Go ahead, be a retail store clerk in like College Park. And like one of my
I can't believe you just said College Park.
Nah, I'm telling you.
I know what you're talking about.
these people, like Indian people, and not just Indian people, but Koreans, Chinese, anytime you work in like some dangerous parts, they don't have a choice. They go and they work where there's need.
But I still
right?
think we need to. Okay, so not a 7. Let's
Different
do a
highway.
Dunkin' Donuts. Let's start a Dunkin' Donuts, Chris. We need to be proper Indians before we die. We need to like
You could say we become doctors.
Okay.
You don't want to become a doctor.
All right. Anyways, I think I'm gonna stop that talk. I think they brought on a whole bunch of topics, ranging from when they started, around the data centers, neo clouds. Um, let's go back here. Yeah, they covered a lot of topics in that video, going back from neo clouds and so on and so forth, and data centers, and how there's just going to be, we're just seeing the beginning of AI infrastructure build out, and so most likely, things, AI is going to be the next thing, and it's just a matter of, are they going to win 2026, or is the market going to take them down? But that's hard to tell. Like, is the market going to take down these types of companies, or what's going to happen here? Um, to me, 2026 it's probably going to be another good year. I think it could be a time where, a whole bunch of these companies that don't actually provide any value get shaken out, and we end up seeing some value creation in the AI industry. And so once those types of companies come into the market, I think things are going to be way, way better. And so, then it's at that point that we can actually expect AI to inflect to the upside. So we could see a rough next year, maybe a rough period right now, just to shake out all the companies that don't have any leg or don't have real technology with real customers, and the ones that are, the actual beneficiaries are gonna be able to continue to make the revenues that they um that they need to operate and make money. But we're gonna go on. We're gonna listen to this video about 42 minutes with Jeremy, and then I'll end the night there.
Can be brutal, and it shakes its tail. Rattler, you hear it, shh. And if you ever hear that noise, you need to get away. It's like a little warning sign of like, hey man, I don't want to do this. I'm about to mess you up. Just get out of here. Yeah, if you don't get out of there, it's going to go ahead and send you to the hospital. And so the market's doing a little bit of rattling now at this point in time. We're looking at Bitcoin. Bitcoin, a huge risk on asset, falling under 100K, is now down over 20% from recent highs. Little market rattling going on. We got the Russell 2000 now down 6% from recent highs. Those small cap stocks, it's usually, if people want to take more risk, they buy the small cap stocks. If they take less risk, they do not want to own small caps. Ethereum, which we can call Bitcoin's little brother, that one is now down over 30% from its all-time high, down about 32% now at this point in time. This is the past 10 days. Looking at stocks that are very popular on X, specifically stocks like Tesla, Palantir, Robinhood, Hims, and Duolingo. These stocks are very popular on X. If you ever go on X and you're on the stock area of X, yeah, you're going to see a lot of these stocks talked about all the time, right? Tesla's down about 15% the past 10 days. Palantir's down 17% the past 10 days. Robinhood's down 18%. Hims is down about 20% the past 10 days. And Duolingo, Little Dingo's down over 30% the past 10 days. The big dog that got everybody very excited just a couple months ago in regards to AI space is Oracle. And look at Oracle. Oracle's now down 32% from the highs it hit less than 60 days ago. An absolute massive fall for Oracle stock. In this video here today, two core subjects we got to speak about in depth. One is I need to explain the bomb that has been set in the market, okay? And exactly what's going on there. We'll talk about the match and all that good stuff in this one here today, okay? We'll explain that at the beginning. Second, stocks that I'm buying, stocks that I'm selling, moves that I'm personally making out there in the market, given what is going on out there. We'll get into all that in this video here today. It's a beast. I've been prepping this video for like the last 4 hours for you guys. I hope you enjoy this one. One thing and one thing only I need from you guys. If you could please just hit that thumbs up button. That's all I need from you. I hope you enjoy me covering all this stuff for you guys on a daily basis. And if you want to be subscribed here, if you want to see more of my videos in the future, make sure you're subscribed. If you're subscribed, higher probability YouTube will show my videos in the future to you. If you're not subscribed, you never know. You might not even be able to see my videos. So make sure you're subscribed here to the channel. Pin comment down there today if you're looking to join my private stock group, private wealth group, get access to all my course curriculums, the private Discord chat, see the moves I'm making each week in my Fidelity account, the public account, 1000xstocks.com access. Demand in there has been ridiculous. We had over 1,000 applications just in the past 2 weeks. It's been overwhelming. Once you join us in there, we'll send you your Steel membership cards. And if you join us on a lifetime basis, we'll send you your lifetime membership card. This baby right here. We'll send that to your house, and that will be the pinned comment down there. We are closing that to new members in December. So keep that in mind. If you want to join, you better get in there ASAP, okay? There will be pinned comment down there. Let's play a little game. So
as you can see, I'm missing quite a few chompers. I'm hoping to find a more permanent solution for my dental situation. I just took a quick 6
The bomb that has been set is pretty fascinating because this is a very complicated bomb. This is not just some like one thing, two thing. No, this is like 7 parts all put together, and it's fascinating to kind of look at it and be like, wow, like all this has been set in place. Like this is actually really fascinating. So part 1 of this is around the biggest companies in the world. Okay, so if we look at the stocks that matter the most to the market indexes, S&P 500, the NASDAQ, they are NVIDIA, Apple, Microsoft, Amazon, Google, Broadcom, Meta, and Tesla, right? Now, 5 of those stocks, Microsoft, Amazon, Google, Meta, and Tesla, they are buying tons of these NVIDIA chips and also Broadcom chips as well, okay? So NVIDIA and Broadcom are really being supported by these other massive companies. Apple's the one outlier here. Apple's not really spending aggressively on AI right now, which is we'll see if that's the right play or the wrong play. It might be the right play in the short term, meaning the next couple years. It might actually be the wrong play long term over the next 10, 20 years. We'll know about that over the next 10, 20 years. Maybe Apple slowly, gets eaten away and it becomes slowly irrelevant over the next 2 decades. But in the short term, they might actually end up looking like the smartest ones in the room in regards to this matter, okay? Now, something very important you got to understand is around depreciation, okay? So if you go buy a bunch of something as a business, over time, you're usually going to depreciate that, right? If it's, let's say you're building a factory, you're going to depreciate that over time. If you're building a hotel, you're going to depreciate that over time. If you're buying a bunch of NVIDIA chips or AMD chips or something like that, you're going to have to depreciate that equipment over time, computers, all that sort of stuff, right? Anybody that's ever run a business, you know exactly what I'm talking about in regards to depreciation. Now, the thing with depreciation, right, is that's going to affect your profitability as a business over time. It's companies put it in different places. Some will basically do it as its own line item. Some will put the depreciation into SG&A. Some will put it into cost of goods sold, depending upon many various factors. But it actually ends up hitting your net income and your EPS over time, right? So here you are, you have all these massive companies like Amazon, Meta, Google, Oracle, all those big dogs, right? You have them buying these NVIDIA chips left and right? And then they're about to go crazy on the AMD chips as well. Now, these chips can sell for around $30,000 a piece, and they're loading the boat on as much as they can get their hands on, right? You're going to have to depreciate this over time, which means down the road, your profitability is going to get hit immensely as this depreciation hits, essentially, right? So let's say you own company Donkey Doo-Doo, we'll call it, okay? So you go out there and you spend $200 billion on NVIDIA chips and AMD chips because you're like, we got this big AI thing we're going after. We're going to, create a $1 trillion company here, okay? So we're going to go spend $200 billion on these NVIDIA and AMD chips, right? You're going to need to depreciate those chips over the next 4 to 6 years, essentially, which once again, it's a non-cash expense when it comes to depreciation because you already spent the money. Like you already spent the money on these chips, but it's going to make your profitability look way less impressive, right? And so it's going to end up hitting your earnings per share hard. And so in future years, it's going to be harder and harder to boost your earnings per share up in any substantial way because that depreciation you're going to have from years ago when you spent $50 billion on NVIDIA chips and AMD chips, right? And all the stuff to go with that. This is something very important that's going to matter for these companies over the next several years. So if you look at a company like Amazon, for instance, Amazon's a massive company that does huge depreciation. Because why does Amazon have so much depreciation and amortization? Well, Amazon, guess what? They build massive warehouses, right, for their e-commerce business. They buy fleets of trucks. They buy fleets of airplanes to fly stuff all over the place, right? Then they have their Amazon Web Services business. So they're buying all these high-end chips all the time, right, for their cloud business. They're a huge cloud service provider. So Amazon is a company that's always going to have insane depreciation. And how big of numbers are we talking? If you look at just last year, Amazon had depreciation and amortization of over $50 billion. Now, if Amazon didn't have all that depreciation and amortization, imagine what Amazon's net income would be. Imagine what their earnings per share was going to be, right? And so this is something that's always negatively very much affected Amazon in regards to profitability. It's also another reason why people are willing to pay a higher PE ratio for this company because they understand, like, if it wasn't for all that depreciation, their profitability would look way better than it is. And once again, depreciation is a non-cash expense, so something to keep in mind there, right? Now, the thing is, when we're talking about companies like Google, companies like Meta, Microsoft, all these others, right, or even Oracle, what is occurring here is they're now becoming very asset-heavy businesses because they're spending so much. So the depreciation and amortization is about to skyrocket for all these companies. And so they're taking their business models from very asset-light business model to very asset-heavy, right? And so think about it in terms of like Shopify versus Amazon. Shopify is an ultimate asset-light business model, right? They're not trying to build massive warehouses and do all the infrastructure that Amazon. Amazon's very asset-heavy. Two very different business models, right? And both can succeed. The thing you have, though, is you have all these companies that were asset-light, like the Metas and the Googles and Oracles and all these companies, now going to asset-heavy. Now, the other thing to keep in mind with an asset-heavy business is what? I'm just dropping gems for you guys. Stay with me, okay? The other issue with an asset-heavy business model is lower margins. Usually, if you're going to go asset-heavy, lower margins. Look at Amazon's margins versus Meta's margins, versus Google's margins, versus Apple's margins. It's a night and day difference, right? A night and day difference. Your margins go down substantially when you start going more asset heavy and you start getting hit with that major depreciation. So this matters significantly here, ladies and gentlemen, and this is an issue we're starting to run into. Now, additionally, when it comes to depreciation schedules, a lot of people think because these chips, let's call it, I don't want to say are irrelevant, but they're not as important after they're 2 or 3 years old. People think you should write it all off within 2 or 3 years, but a lot of these companies, what they're doing is 4 to 6 year depreciation schedules is something, people make fun of that are really, really into finance, is Amazon changing their depreciation schedule in the past, and then Microsoft, Google, and Meta, and other companies like following that over time, right? And that way you don't get hit as hard. Because if you were to, let's say you're, company Donkey Doo, right, and you spend $50 billion in a year on NVIDIA and AMD chips, and you got to take that full depreciation in 1 year or even 2 years, ooh, that's going to make your net income, your earnings per share look bad. That's a heavy hit. Now, if you can take that hit over 4 or 6 years, much less of a hit, right? So that's something to kind of keep in mind there. And these companies, who knows, they might try to even push it out further if they can get away with it, right, in regards to that. And so it makes you start to think about these companies the same way you would think about a company like I own called Wynn Resorts. Wynn Resorts, unbelievable company, high-end gaming company, right, the highest end out there. They got unbelievable properties here in my city, Las Vegas. They have unbelievable properties in Macau. They're the creme de la creme. They're building a property right now. It's insane in the Middle East. And there's a company that spends multi-billion dollars when they open a resort, right? And they're a heavy depreciation business because they're going to depreciate that property over the years. And that number is big for the company. Like, look at this company in terms of their revenues. They brought in $1.8 billion of revenue in their latest quarter. Massive number. That's incredible. They have 2 resorts in Vegas. They have 3 resorts in Macau. And then they operate a property in Boston. The Middle East property is not even open yet. 6 properties in this company in a 3-month span did $1.8 billion. Unbelievable company, right? But look at the depreciation and amortization here. $152 million, guys. We're talking about almost 10% of the company's operating revenues basically gets taken away by depreciation and amortization. That's a big number. That's a very big number for this company, right? I mean, we're talking about that number so massive. I mean, geez, it's bigger than the rooms expense. Not only bigger, but it's like twice the amount of rooms expense. That's insane, man. Very. Now, the other thing that matters significantly here is if you were looking at resort companies, there's a other big issue with these companies. There's something else that snags a lot of their money and makes them not look nearly as profitable. And this is a cash expense, this next thing we're about to go over, okay? And you know what it is? Debt. If you're a big company like Wynn Resorts, you don't just have $5 billion sitting around to go build yourself a new massive resort somewhere. So what you're going to do is you're going to take out debt to do that, right? And so if you look in this latest quarter, interest expense for Wynn Resorts was $157 million. So you go ahead and take a cash expense like interest expense and a non-cash expense like depreciation and amortization. We're talking that's over $300 million for this company, right? And so they're still able to have good net income, right? Net income for Wynn Resorts Limited, $88 million. So that's still a good number. But if it wasn't for all that interest expense and depreciation and amortization, we'd be looking at a number that's like, we'd be looking at a number that's closer to $400 million, ladies and gentlemen, which completely changes because if they can do $400 million in net income a quarter, that's $1.6 billion a year in net income. If you're willing to pay, a 20-something PE ratio on that, then you're willing to pay easily a $30-40 billion market cap on this company. But that interest expense and the depreciation and amortization eats it. But here's the issue with the big dog companies, right? So far, those big dog companies that are making all these massive orders and building out this infrastructure, right, all these data centers, they're doing it through cash flow, through profits right now. But if they keep increasing the way they're increasing, eventually they're going to be basically spending more than they even have coming through the door, which means what? They're going to have to start taking out debt to build these properties. And so it's all being cool until we've gotten to this place right now where people are looking and you hear Meta saying they're going to spend a lot more next year than they spent this year. And people are like, excuse me? So you're going to spend more money in the next year on infrastructure than you even have coming in terms of profitability. So what are we looking at here? Are we looking at taking out a bunch of debt? And that's the same way they're going to be looking at Microsoft, or Oracle's already debt loaded. And there's a lot of people that believe they're about to go insane with debt levels, right? Now we're talking about a whole different game because that debt eventually needs to get paid off. And so you're going to start having massive interest expense each year away. So now all of a sudden you're going to become a resort company. You're going to become a Wynn Resorts, loaded with debt, right? And tons of depreciation and amortization. All of a sudden, people aren't going to look at these stocks as like the holy grail stocks anymore. The holy grail stocks were high margin, asset light. Oh, beautiful. And they can just flood money in like an ATM machine and just buy back shares. Now people are like, they're going asset heavy, margin's probably going to go down, massive depreciation. All of a sudden they start taking out debt over the next couple of years. You got a bunch of interest expense. And people start saying, do we really want to own big tech? And guess what? Like we started this video, big tech is what runs the market. Could we have a changing of the guard? Now, this is why this next part's very important. Oracle, Meta, Google, Amazon, Microsoft, Tesla, all these companies that are spending fortunes on all these chips and all this infrastructure, right? They better start to show massive revenue growth in 26, 27. If they don't, and if they just are still growing around the growth rates they've been growing at, people are going to start flooding out of these stocks. And the reason being is you're now several years into the chip cycle. Remember, these companies all started ordering these chips in 2023. And then they upped the amount in 2024 and upped it in 2025. Now, we've seen nice acceleration of growth in Meta. Meta, latest quarter, they grew revenue 26%. The issue is even for a company like Meta, they got to keep growing 26% or maybe even take that into the 30s to justify all this spend. Where investors say, okay, we get it. They're spending like drunken sailors, but you know what? The revenue growth is insane. So we're going to give them a pass on this. Buy the stock. Google, Amazon, Microsoft, all these companies, Tesla, they better start coming through with insane revenue growth in 26 and 27. If they don't, there will be a reckoning on all these stocks, which means a reckoning on the market itself, right? Where you can see many of these stocks fall 20 to 40% from these levels they're at right now. As investors push back and say, dude, we don't like the way your business model is going. You're going from asset light to asset heavy. You're going to massive depreciation. You might start taking out debt. We're good. We'll buy something else. Like we don't want what you're pushing. Okay. The only way they can get away with it is if they start having massive growth rates. Because then that would show investors like, okay, yeah, they're spending so much, but look at the revenue growth. That's a distraction. So then you could get away with it. You don't come through with that big revenue growth. Like Amazon took their AWS growth this recent quarter up to 20% from 17. That's a good start. They better keep that going. You need Amazon to start getting to AWS growth of 25%, 30%, 35% for people to say, okay, Amazon's spending a fortune, but look at that growth, right? It's all going to be worth in the end. You need somebody like a Meta to accelerate growth rates up to 30% plus. So then everybody say, you know what? Okay, yeah, they're spending a fortune, but look, it's clearly producing results, and they're massive results. Because 26% growth is not getting investors excited enough now at this point in time. So the sweat is building. It is building now at this point in time. That was just part one of the bomb, by the way. That was just part one. Part two of the bomb is we have a market that's very rich. We all know that. I've been talking about it on the channel for the last several months now at this point in time. Forward P is high, right? We got a forward P on the market of about 23, which if you look at any point in the past 5 years, very high. And guess what? Every time it usually reaches right around this level, guess what happens? Market falls a bunch, and that forward P comes down substantially. So we're at a point in time now where you're looking and you're like, looks like the market's due to have a little come down here. And, look at the other two times. We went high right here, boom. We went high right here, boom. So it looks like a ticking time bomb situation here, right? Now, additionally, part 3 has to do with the government, right? U.S. October employment report will not include jobless rate. So this is people looking and they're like, what's actually going on with the economy? And why does the government not want to put out these numbers? Is it because truly they feel like they can't accurately have the numbers, or is it because they're hiding something? And that leads to a lot of fear, right? And that fear comes up. And then you see something like this come out today. New foreclosures jumped 20% in October, a sign more distress in the housing market. Look at this. Foreclosure starts, which are the initial phase of the process, rose 6% for the month and were 20% higher than a year before. Completed foreclosures, the final phase, were up 32% year over year. Florida, South Carolina, Illinois led the nation in state foreclosure filings. That's a little worrisome. When you start seeing foreclosure starting to spike, that starts reminding you of what? 2008, right? And so that's something people look at and they're like, okay, wait, what's the government hiding in the data? And why are foreclosures spiking like this? That definitely leads fear. Part 5. Everybody thought it was a done deal, rate cuts in December, right? Now the market's getting scared about maybe there's not going to be rate cuts. Market no longer view the December rate cut as a sure bet, with Fed officials casting doubts. Federal Reserve Chair Jerome Powell wasn't kidding a couple weeks ago when he said the December rate cut wasn't in the bag, whereas traders, as recently as a few days ago, were pricing in at least 2-to-1 probability to a quarter percentage point cut that has now flipped to a coin toss, 50-50. As markets grew much less confident about a December cut, stocks slumped. So now we're like, okay, are we getting a rate cut? Are we not getting a rate cut? There's a lot of fear about that now at this point in time. Part 6, the 10-year treasury. Remember what I always tell you guys, the housing market is what drives the U.S. economy or takes the U.S. economy down, right?
What happens if my dad starts Tai Chi tomorrow?
How old is your father?
He is 56.
Oh, perfect. By the end of September, you won't even recognize.
The issue we have is that 10 years not falling, right? And a lot of people expected that 10-year at this point in time to be in the 3s by now. And it is just holding steady above that 4% line, which means mortgage rates aren't coming to where people want mortgage rates to come down to, right? Which means then people aren't going to buy new homes, which means construction's not there. And that produces just so many jobs when a new home is built, right? Plus all the people that make money when a home transaction goes through. It's a big expense. Like there's so many companies and so many businesses that make money every time a home is sold, and especially every time a new home is built. And we just can't get that 10-year treasury down. So that's a big problem out there right now. It's getting so bad. You're seeing things like this. I saw this yesterday. A friend sent me this. D.R. Horton, America's largest home builder, valued at $43 billion, is currently advertising mortgage accounts in certain Florida communities like this. Year 1, you only have a interest rate of 0.99. Year 2, 1.99. Year 3, 2.99. Woo boy. Okay, so why are they doing that? My guess is they probably built a lot of spec inventory. This is just my guess, okay? As somebody who's bought plenty of homes from these home builders over the years and followed this industry, and have even owned Toll Brothers stock in the past and listened to a million of their conference calls. What happens sometimes is home builders were assuming the real estate market picking up by this point in time. Guess what? It's not picking up. It's still dead. Still completely dead. And these home builders probably started to build a bunch of spec inventory at the end of last year and into the beginning of this year, figuring, by the back half of 2025, things will be good, right? Trump won the election, like real estate's going to come back, mortgage rate's going to fall, it's all going to be good. Guess what? Hasn't happened. It's still dead out there. And so now these home builders like D.R. Horton is like, what do? We got to do something to incentivize. Do we just slash price? Ooh, you slash price, that's not good, because then that means you've got to slash price on your whole inventory, which means then that means in your future homes, price has to be slashed as well, likely in 2026, right? And that means also the existing inventory will slash price as well, and you start to have this like really bad problem, right? So the best solution for you is to do something like mortgage rate buy down, since that's a big sticking point for folks right now, right? Get those mortgage rates down, maybe you can sell inventory that way. We'll see. It might work, right, for some of those communities. But that then puts pressure on existing home sellers because they don't have that pull, they don't have that core to pull there. So what they're going to have to do is they're going to have to adjust price, which then ends up still hitting somebody like a D.R. Horton at that point in time, right? Part 7, I was looking at something like this. Congressional hemp restrictions threaten $28 billion industry, sends companies scrambling. The congressional funding bill, including a THC cap that effectively bans most hemp products, a move industry leaders say threaten a $28 billion industry. More than 300,000 jobs are at risk. This is just another thing here today, right, that is starting to lead people to say, wait a minute, we thought this government was going to be pro-business. I'm not so sure about that, right? People are starting to look at the government as maybe this is an anti-government business. You've got the tariffs that have obviously decimated companies' profits and those sorts of things because they have to pay the tariffs, and then that ends up getting pushed down to the consumer if they can push it down to the consumer over time, right? You got the government saying you can't sell this, you can't sell that to China, right? Basically, NVIDIA and AMD's business is dunzo in China in regards to the AI business, right? They got nothing going on there. So it's like you can't do business in China, right? You're kicking your customers out of the country, obviously with all the immigration and whatnot, right? There's no doubt like that has a very negative effect on the economy, the U.S. economy. You're going to kick millions and millions and millions of people out of the United States. Like, that's you know, at the end of the day, like it's, you know, people that spend money in the economy. So you got all that going on. People are like, is this government really pro-business? Because what it's seeming like is more anti-business, right? And then you even look at like farmers. Like farmers have had a brutal year this year from everything I've heard in regards to this, right? It is not good time to be a farmer. And the farmers are dealing with a whole host of problems. But guess what? My hunch is a lot of farmers had a lot of illegal labor. I think that's a fair point, is it not? Or are we just going to act like this doesn't go on? My guess is the farming industry hires a lot of illegals, right? Illegals got kicked out of the country in mass. So now what do? Well, now your cost of doing business just went up immensely. And eventually that has to get passed on to the consumer, which leads to inflation between all these tariffs and all this stuff and stuff like this, right? Guess what it ends up leading to? The consumer gets hit with that inflation end, which then means if inflation numbers are higher, the Fed can't lower as fast. And that means the 10-year stays higher, so real estate can't get moving. It's a whole domino effect that's just very, very bad, right? And so you kicked out all the illegals. And so, but the good news is, like, the realtors probably aren't selling any properties right now because the real estate industry is dead. So maybe these gals can go work in the farming industry and help the farmers out. And I'm sure that will work out well. I'm sure they're going to work for $10 an hour, 10 hours a day in the sun, huh? No, you got to ask yourself, okay, we have all this stuff that's put together here for the bomb. How do you ignite the bomb? Well, all right, I'll tell you guys a little something that's going on behind the scenes right now. You're not going to hear this talked about on CNBC. You're not going to hear this talked about on Bloomberg. You're not going to hear this talked about, okay? Shh. This is stuff on the real DL right now, okay? Like backroom stuff, okay? So, I'm sure you guys are aware, you might have heard of the new release of some Epstein files.
All right, so he's going to get into politics. I'm going to end it there. I think it's all I got. Thank you so much for joining me. Make sure you subscribe if you haven't. This is Financial Education and Business signing out. Have a good night.